the conversation, the tenor of the conversation, as being excellent. The tone and spirit of the conversation were excellent. He said, if it wasn't, I would say so now rather than later. Read into that how you will. But to your point, Nick, on no mention of sanctions in this post, is this a testament to the threat of sanctions, which President Trump said he was willing to impose? Caroline Leavitt, the White House press secretary today, said everything would be on the table in that regard if Russia isn't playing ball the way the administration wants. Is this a testament to sanction threats working or not?
Well, I mean, very initial impressions here, of course, but to me it is a suggestion that President Trump does not believe the sanctions threat is necessary. I mean, he seems to be signaling that there's progress here. They're moving in the right directions. He's not going to want to spoil that with a potential announcement on sanctions. He's not saying progress or else. He's just saying, hey, we're doing it. The process is launched, and suggesting that his phone call with President Putin is the reason why the process has begun, when, of course, you know, there have been conversations back and forth via intermediaries and then directly, as you mentioned, in Turkey by Russia and Ukraine, but so far, no ceasefire.
What do you make of the Vatican involvement here? I have to admit, it smacks of the optics that you would think Trump would really like.
Sure. I mean, I think at this point...
Does it add to the drama or the urgency around this? What does it bring to the conversation?
I mean, you know, in the theory of throw spaghetti against a wall and see what sticks, why not? I mean, the UN has been essentially discredited and frozen because of the clash in the Security Council between the U.S. and Russia. There is some concern about, you know, if the U.S. is the mediator, whose side are they really on, as evidenced by President Trump's truth. So if you have a truly disinterested / impartial venue, the Vatican, why not? Let's give it a shot. New Pope, new day. Maybe there is a way under which you could get the parties in a room together and there might be slightly less mistrust. I don't know. I mean, it's just another notion that's out there that in the past you wouldn't have even heard about, I think, but in this sort of radical transparency where President Trump just broadcasts everything from truth, now we have to contend with it. I don't think anyone really has much idea what that means right now.
Well, amazing.
And finally, Nick, President Trump gives a number of specific shout-outs in this post to people he spoke with after speaking with Vladimir Putin on a phone call. Vladimir Zelensky, Ursula von der Leyen, the president of the European Commission, the presidents of France, the prime minister of Italy, the chancellor of Germany, the president of Finland. Everybody got together, all of the allies of Ukraine, if you will, spoke immediately after he got off the phone with Russia.
Well, I mean, the question is what was actually in those conversations and what was the tenor? I mean, the European leaders are deeply uneasy with President Trump having this one-on-one call with Vladimir Putin. They just say, for one thing, there's no need, and it would seem to serve Putin's purposes of splitting the U.S. away from Europe. So we're really going to need to see what came from those calls. If President Trump went to those and said, okay, don't worry, if we don't see progress by such and such a date, we're going to impose sanctions. Well, that's one thing. If you went to them and said, go stuff it, we're going for this thing, progress is continuing, butt out, a much different... They're trying to telegraph unity there, but it's hard to tell if that goes any deeper than the surface.
All right. Bloomberg's Nick Wadhams leading our national security team here in Washington as we grapple with this breaking news. Thank you so much. Again, President Trump providing the readout of his 2-hour-long phone call with Vladimir Putin on Truth Social, saying that Russia and Ukraine will start ceasefire talks immediately, describing as a process beginning, even though the U.S. had already been trying to broker a ceasefire, granted through bilateral negotiations separately with Russia and Ukraine rather than Russia and Ukraine directly talking, but 4 months now, really since he came into office.
Well, that's right. And to your point, just last weekend there was a session that the president of Russia decided not to send his top lieutenants to. The Secretary of State, Marco Rubio, was there. Steve Witkoff was there, and they were dealing with much lower-level officials at the table, questioning again the motivations and intentions coming from the Kremlin.
Well, we want to get a read on how Melinda Herring is viewing the Kremlin's intentions and motivations here with what we're reading. She, of course, is senior fellow with the Atlantic Council's Eurasia Center and is one of the experts we love speaking with on the war in Ukraine specifically. Melinda, welcome back to Balance of Power on Bloomberg TV Radio and now Bloomberg Originals. I do wonder what's going through your head as we look at the words of President Trump, that negotiations toward a ceasefire and an end to the war will start immediately. Does that fill you with confidence or skepticism?
Hey, Kaylee. So, no, it does not fill me with confidence. And I think it's important to not just look at what Trump said, but also to look at what Putin's saying. So let's take a pause for a moment. Putin has grabbed the microphone and he's talking about a memorandum which will outline all the conditions, and then maybe there'll be a ceasefire. So I don't have a lot of confidence that this is going anywhere. The Europeans threatened Putin a week ago and said if he didn't agree to a 30-day ceasefire, that there would be massive sanctions, and there was nothing there. So I think this may be a lot of hot air yet again.
Well, you could look at this, I'm sure, a lot of different ways, Melinda. We're waiting for an official readout from the White House, and I don't suspect it'll disagree with what you heard from President Trump. Slightly different, though, than what we did hear from the Kremlin. And when you hear Vladimir Putin talking about getting down to the roots of the invasion, the roots of the conflict, what does that say to you? And is it possible to have negotiations while the fighting continues?
Joe, that's really the question. So Russian demands haven't changed over the last 3 years. And the negotiations broke down in Istanbul on Friday because Russia went back to its demands. And this time it said we must have not only Crimea, but 4 of those oblasts in eastern Ukraine. And they don't completely control those Ukrainian oblasts. And the Ukrainians said, stuff it. So it's hard to see that this discussion is going to move anywhere. It's good that the Vatican's involved. It's good that the Europeans and the Americans are working together. But when Putin talks about intent, he means NATO, and he's blaming Ukraine for insisting on sovereignty as the cause of the war. That's what this coded language is.
Well, Melinda, to your point about Russia wanting the recognition of Ukrainian territory as its own, despite the fact that it does not have many of these areas in its full control, does Russia right now have the military advantage to be able to get those areas under control? I just wonder the strength of each side's position here if they are indeed about to join together at one table for these talks.
So right now, you know that Russia controls Crimea. It illegally annexed that province. But in terms of those 4 other oblasts, they control about 20% of Ukraine, and it depends on the oblast. Russia does have the momentum on its side, but it's very slow going. If you look at the Institute for the Study of Wars report, it's very, very small progress. The Ukrainians are holding the front with drones, but there is an expectation that the Russians are going to make a push this summer, and the expectation from the Russian side is that they're going to be able to take all 4 of those provinces by the end of the year. I think that may be an overstatement, but that's the Russian expectation.
Well, then it sounds like you can't negotiate when you're in the throes of fighting. We just saw one of the biggest drone barrages against Kyiv of the war so far, just in the last 24 hours. Melinda, at what point does the White House lose patience for this?
That's right, Joe. So over the weekend, Russia hit Ukraine with 273 drones across the country, and they want to increase that number. They're trying to overwhelm the Ukrainians' air interceptor system, their air defense system. But you can't negotiate in an ongoing war. So we're all looking for the ceasefire. President Trump has been great on this. He called for a 30-day ceasefire. He's been calling for that for weeks now, and Putin won't agree to it. So I really encourage our viewers to keep your eye on the ceasefire part of this. If he doesn't agree to a ceasefire, there's not going to be any real negotiations. And we see him again stalling for time and talking about, he wants to get into these weedy details, Joe, so that he can delay the ceasefire. And let's go back to Easter. He demanded a 3-day ceasefire right after Easter when he was having this big May Day parade. And he can call his troops off. It's up to him. So when he starts to get weedy, it means that he doesn't want to do something.
Well, and when we consider even just the prospect of a ceasefire beginning, Melinda, what are the enforcement mechanisms or what keeps both sides honest on maintaining that ceasefire? If it's also just the 2 of them at the negotiating table versus having some sort of mediator, what would guarantee that it holds?
That's a great question. In this case, you need an external mediator, and we don't know who that would be. It can't be the OSCE because both Ukraine and Russia are party to the OSCE. So we're going to need some kind of neutral mediator to make sure that once a ceasefire is in place, it can be observed by outsiders and that the rules of the negotiations are very clear. So in this case, we haven't seen the details, and I'm not sure who could do that job capably.
The president writes, Melinda, the Vatican, as represented by the Pope, has stated it would be very interested in hosting the negotiations. Are we to believe that the Vatican would be involved on any level of mediation here? What would that mean for talks?
So the Vatican has offered to host negotiations, and the new Pope has it feels very different, Joe, than the previous Pope on Ukraine. He's been clear that Ukraine is the victim, and he, both there are quite a few Roman Catholics in the Trump administration, so I think that sort of appeals to them. And we've seen Zelensky also do his big meeting with Trump there at the Vatican. So I think this is a good sign that this could be one of the potential places where the parties can meet and discuss their friction. But, TBD, everyone wants to host these negotiations. Turkey would love to, Qatar would love to, everyone wants credit for the end of the war. So I think we're going to have to stay tuned with that one as well.
Melinda, it's great to have you with us. Melinda Herring, as we learn some of the details of this meeting between the two presidents, senior fellow at the Atlantic Council's Eurasia Center. We should note, Kaylee, that the Truth Social post that we've been describing and reading from by President Trump was sent out by the White House. So we'll call that our official statement.
Yep. And of course, that official statement included this breaking news that Russia and Ukraine will begin immediately direct negotiations for a ceasefire and the end of the war. I guess we'll have to wait and see how immediately that actually will be. And
Indeed.
That's one story that we're tracking here in Washington, but there's another we should keep tabs on as well. As the Speaker of the House, Mike Johnson, just spoke to reporters on Capitol Hill saying that Republicans are almost there on their big tax bill. He says they're very confident they will get this done, but there's still a few issues we need to resolve, reminding us, Joe, that a lot of those specific details still not hammered out in terms of what's going to make everyone happy.
But a 1 a.m. committee hearing looming on Wednesday. We've got a lot to figure out this week, and we're going to be talking with one of the stakeholders in that conversation. Join us 5 p.m. Eastern Time for the late edition of Balance of Power. We'll meet you back here on Bloomberg.
This is Bloomberg Business Week Daily, reporting from the magazine that helps global leaders stay ahead, with insight on the people, companies, and trends shaping today's complex economy, plus global business, finance, and tech news as it happens. Bloomberg Business Week Daily with Carol Masser and Tim Stenivek, live on Bloomberg Radio, television, YouTube, and Bloomberg Originals.
All right, everybody. What about that downgrade? Because it feels like it happened Friday. I thought the world was going to fall apart, and yet we're off our lows of the session, at least when it comes to the equity side of things.
I mean, basically over the weekend, Carol, investors were saying to themselves, Monday's going to be a little ugly if you're long this market. We think equities are going to go down. They started the day lower. Now, we're going to have an update from Charlie Pellet in just a minute, but suffice it to say we're flat on the S&P 500.
Don't cue the music yet, folks, because coming up over the next 60 minutes, we have a great roundup. We are going to talk with Raphael Bostic. Actually, our Mike McKee is going to. Of course, the president of the Atlanta Fed. Curious to see what he has to say. He's been out there already talking about maybe only one rate cut this year by the U.S. Central Bank. So we'll see what Mike gets out of him additionally.
Also, we're thinking about what's happening around the world. The president just wrapping up that 2-hour call with Vladimir Putin of Russia. We're going to be joined by a group, a roundtable. We got a great couple of guests coming up on the program to really give us an understanding of, where is this conflict going and is it really wrapping up?
Yeah, Libby Cantrell over at PIMCO is going to join us. She knows so much and talks about public policy, macro policy, so we'll get into that. And we also have the CEO of John Hancock Insurance. I always am curious about, Tim, CEOs, heads of companies, how they are taking the macro, the micro, and then kind of moving ahead. So lots coming in the next 60 minutes. First up, though, let's get a check on that trade today. Here is Charlie Pellet.
Thank you very much. And here's what's going on. We've got the Dow higher, the S&P little change, NASDAQ in the red. Got to keep in mind that at the worst level of the day, we had the S&P 500 index down by more than 1% right now. Little change, down under 0.1%, just about flat on the day, down 2 points on the S&P. The Dow up 86, up 0.2%. NASDAQ down 24 for the NASDAQ Composite Index, a drop there of 0.1%. 10-year 4.47% with the 2-year 3.97%. Spot gold right now up 0.7%. The precious metal pushing higher, 32.25 the ounce. Oil is falling as President Trump says Russia and Ukraine will start ceasefire talks. Right now, West Texas Intermediate crude down 0.1%. 62.40 on WTI. Again, gold up 0.7. S&P little changed on the day, down under 0.1%. Nippon Steel plans to invest $14 billion in U.S. steel if the Trump administration approves the merger of the companies. This, according to Reuters. Right now, U.S. Steel up 1.6%. ADRs of Nippon Steel, they're down by 1.4%. For on-demand news 24 hours a day, subscribe to Bloomberg News Now wherever you get your podcasts. I'm Charlie Pellet. That is a Bloomberg Business Flash.
All right, Charlie, thank you so much. Charlie there with the market set up on this Monday. There is a lot going on, and of course, Tim mentioned at the top of the hour that President Trump and President Putin of Russia having a more than 2-hour conversation. That's part of the geopolitical macro that we are kind of digesting on this Monday. We came into it, though, dealing with that Moody's downgrade, which happened late Friday. I'm kind of surprised at the support, but if you look at treasuries on the longer end of the yield curve, you definitely see some movement there. So, and let's not forget, Tim, right, we've got a tax bill that's kind of working its way through the U.S. Congress.
Watching all of this is Libby Cantrell, Managing Director and Head of Public Policy over at PIMCO. She joins us from New York City. Libby, I want to start with the downgrade from over the weekend. It's fair to call it over the weekend. I'd say it happened during our program, during the 4 o'clock hour, after the markets were closed. Investors who were along the market were certainly braced to see something happen today. That happened early in the morning, but at least on the equity side of things, didn't pan out or hasn't panned out throughout the day today. What's your view on a downgrade such as this?
Yeah, well, good afternoon. I think in many ways this is confirmation of something that we already know, which is that the debt trajectory, the fiscal trajectory of the United States is on what seemingly an untenable path with fiscal deficits running around 6% during a very strong economic environment, at least up until this year. So I'm not sure that it really provided us any new news. I think the most kind of consequential potential impact, though, is does this impact the trajectory of the tax bill that, as you both referred to as being considered by Congress. And I think, our answer is probably not. Does this give maybe a little bit more of a talking point for those budget hawks? And there still are some deficit hawks in Congress, maybe. But I think that the sort of the practical implication here is that Speaker Johnson knows he needs to get something passed. And he probably will, as we've talked to our clients, it's easier to give kids candy than to take away their toys. And so most likely easier to pass a bill with more tax cuts and fewer spending cuts. And again, Moody's downgrade probably is not going to have big implication on the trajectory of that bill.
Yeah. It certainly didn't feel like the first downgrade, right? Many years ago when it was kind of a shocker, Libby, on that late Friday afternoon.
2011 was that one, right?
It's a while ago. I think that was a bit of a shocker. Exactly. Having said that, Libby, what kind of, tax and spending bill, I should say, that goes through Congress is going to be an important one in terms of, you look at policy that's an important one for the country going forward in terms of domestic policy, or one that is good, that creates growth longer term, one that doesn't necessarily hurt citizens too much either.
Yeah, I think that, again, there's going to be some hand-wringing among Republicans here in terms of kind of what provisions are ultimately in the bill. But the upshot is, while, seemingly impossible, passage of the tax bill is also inevitable. And that's just because the alternative is just not viable for Republicans. They can't simply oversee a fiscal cliff of around $4 trillion when many of those Trump tax cuts from 2017 are going to expire at the end of this year. So I think the upshot here is that, again, despite concerns around the fiscal trajectory, and certainly we have those at PIMCO, our clients have them, that this bill will ultimately be passed. I think that another big takeaway though for investors here is just the structure of the bill, at least as of now. Now this is definitely subject to change. In some ways, we're still in maybe the fifth or the sixth inning of this whole tax bill process. But as of now, this looks like a much more front-loaded tax bill, meaning that there are more tax cuts, both in 2025 retroactively and in 2026, most likely aimed to mitigate some of that tariff impact. Now, again, it kind of remains to be seen what the ultimate bill will look like. But as of now, you could see a fiscal impulse of about 0.5% of GDP in 2026. So, again, this is sort of, we've been sort of characterizing this as vegetables and dessert. Vegetables are the tariffs, dessert are the tax bill. The dessert is coming. And again, it looks like the dessert is going to be kind of more front-loaded, if you will, relative to what I think many people expected at the beginning of this year.
Yeah, kind of interesting, certainly as we think about the economic impact going forward, certainly shorter term versus longer term. Libby, I want to go back to what you said, that you certainly are hearing about concerns about the U.S. fiscal situation, certainly from PIMCO clients and investors. Tell us more specifically what's top of mind and what it differs from, or how it differs from maybe some of the conversations you've been having over the last year or two.
Well, I think a lot of our clients were, had a big overweight to the United States coming into this year with this very kind of robust economic outlook. Again, more focused on the dessert, if you will, than the vegetables coming into the year. So I think a lot of our clients have just been, in many ways, kind of right-sizing their portfolios, particularly their dollar exposure, which of course is easier to implement than maybe, say, a U.S. Treasuries, change. So in some ways, I think our clients are just, maybe it's not a referendum against the dollar, maybe it's not a referendum against U.S. Treasuries, but it's really trying to kind of reevaluate their allocation to the United States just broadly.
What do you think about U.S. exceptionalism? As you said, it's interesting, coming back from Milken, people said, what we realized, or what everybody was saying, it was a case of, wait a minute, we're just overweight the U.S., we need to rebalance, which is what any good investor does. So yeah, we want to put some more money out to Europe. Is that what's going on, or is it really people saying, I'm not so sure I feel as comfortable investing in the U.S. market?
Well, I think, broadly our view is that, two things can be true. One is that the dollar might be overvalued given just, again, where the economic outlook looks like it's going to be with tariffs and some of these other cross currents in the U.S. economy. But also that this is not necessarily a referendum on the U.S. more broadly. If you just think about all of the things that made the U.S. attractive coming into this year, those things, more or less are still intact. So I think, what we're telling our our clients is that, again, these fiscal worries have been a concern not only for the past year, but for the past years. And at some point, Congress will have to do something about it. Fortunately, there is actually a lot of fiscal runway for the U.S. We just had our secular forum here at PIMCO last week, and we talked a lot about how kind of the different tools Congress has in order to increase revenues or cut spending relative to other countries. And actually, we have a lot more runway, particularly around taxes, meaning that we could actually increase taxes. Now, again, the political will has to be there, but we're confident that if there really is a crisis, that Congress will actually, when push comes to shove, will actually, get to the business of doing some fiscal consolidation. We don't think that's going to happen anytime soon, but we do think that, again, there is the latitude and the runway to do that, kind of when push comes to shove.
Libby, given everything happening, not just when it comes to the credit rating, but also when it comes to the tax bill, I'm taking a look at the bond market. The 30-year yield rising above 5% briefly earlier in the session, now down at about 4.95%. What's the story the bond market is telling us about the long-term fiscal health of the U.S. economy?
Well, in many ways, I mean, I think that, this is what, again, if you just take a step back, coming into this year, even before the election, what we were telling our clients is that fiscal deficits were going to be the biggest loser, regardless of who won, whether it was going to be Kamala Harris or President Trump. And I think in some ways the yield curve, the shape of the yield curve, a more steepener, more bear steepener, meaning the long end being higher, is just reflective of that view that, yes, deficits are high. There doesn't look to be the political will for fiscal consolidation anytime soon.
Right.
And as a result, investors who are investing the long end should get some, some yield premium. And that's what I think what we're seeing in the market today.
Hey, Libby, last question. Just got about 30 seconds here. The point is, though, I think about the other matter, tariffs, which right now we're not talking maybe as much about right now with everything else that's going on, but still out there and still historically high. That's got to have an impact.
Still out there, and this is what we're telling our clients. Our signal from noise here, effective tariff rate looks like it's going to be about 15%. That compares to 3% at the beginning of the year, the highest effective tariff rate since like the 1940s, if not earlier. So I think that this is like, again, in terms of the headwinds for this economy, and that obviously affects the bond market as well, we are still going to see lower growth because of these tariffs. And even though there is this China truce, at least for the next 90 days or so.
All right, great point to end on. Hey, Libby, thank you so much. As always, Libby Cantrell, she's Managing Director, Head of Public Policy over at PIMCO, joining us right here in New York City, which is, I think, a great setup for where we want to go next, Tim.
And that's directly to the equity market, because it really seems to be taking all of this in stride when it comes to Moody's downgrade of U.S. debt. Off our worst levels of the day, the S&P 500 pretty much flat, but down less than 0.1%. So she tackles this all the time. We're bringing her back. It's Gina Martin-Adams. She's Chief Equity Strategist at Bloomberg Intelligence. Gina, I want to start with the short term. When it comes to a decision such as this from a credit rating agency like Moody's to downgrade the U.S., to then go sort of long term with you, starting though with the equity market reaction that we saw earlier today, and then that we're seeing right now, where essentially we don't really care about this. What's your view?
Yeah. I think the equity market, when it comes to these types of things, takes their cues from the bond market, frankly, who is a lot closer to assessing the impact of fiscal deficits and or rating agency sort of views of the broader fiscal situation. And the bond market is taking it in relative stride as well. So unless the bond market were really freaking out, so to speak, it's difficult to say the equity market would really take this news differently. I do think longer term, there is an interesting conflict underneath the surface of the equity market in that yields are suggesting maybe we won't get the Feddies that we were anticipating at the end of the year. And the equity market does seem to be priced for both a Feddies and better growth emerging. So there's a bit of a conflict inside the equity market right now that does need to be resolved. I think until, frankly, we get to the end of the 90-day pause and we really have some certainty as to what the economic outlook is going to look like, the result is the equity market will just trade with momentum. As long as momentum is improving, the equity market improves. As if momentum turns over, then we would experience more declines again. But for now, the momentum is on the side of the bull trend.
Interesting. I got to tell you something, Gina. I'm a list maker, right? And I like to check off my things. And I still feel like there's still a lot of things, though, that investors need to check off. And I was just thinking, we came off of Libby Cantrell of PIMCO, and she said, let's not forget, tariffs are still high. We have this 90-day pause. We're still kind of waiting for the particulars to understand exactly what the climate is. And even if once we have that certainty, it could be a very different dynamic for companies going forward.
Yeah, and I think that's a very good point. I do think that we're seeing that, but only a tiny bit in terms of the market, mostly because of the pause. The nature of the pause is being interpreted by the equity market as only temporary downside with resolution coming. And we don't know for sure that resolution is coming, but the equity market is going to trade that way until we know for sure. I think it's important to keep in mind that the equity market's default direction is higher, and we've talked about this a lot. The equity market drops and drops precipitously when it drops, but most of the time equities rise because the long-term profitability outlook is improving. In the short run, we don't exactly know that we can say that with certainty. And that's really tough for an equity investor because you're basically betting on the idea that the pause will end with certainty and certainty to the positive, with lower tariffs over time, or at the very least, not worse tariffs than exist today. That's a tough bet to make to some, but the equity market is definitely making that bet right now.
Well, why doesn't it seem like the equity market fully prices this in or fully gets this? At least to me, a layperson, Gina. I mean, we're up 20% from those April 8th lows, yet we don't have a clear, distinct policy difference than we had on Liberation Day. We've had pauses.
Yeah, I mean, all the equity market knows is that it's not as bad as Liberation Day. And at least in the short run, that's all it needs to know until we get that certainty. I think that is really tough. But I think it's the nature of how stocks price events, right? A 20% decline in stocks prices a tremendous amount of risk. We're still in the process of unwinding that tremendous amount of risk that emerged as of Liberation Day. Apologies.
That's okay.
But we have to determine whether or not that's the appropriate unwind. We won't know until the end of the 90 days, but in the process, we're going to continue to unwind it until we get news otherwise, is the best way that I can describe it. The other wiggle in this is what's happening with economic data, and this goes back to your other points. The equity market will only ignore deteriorating economic data for so long. Our work suggests that even at a 20% drop, we didn't price recession emerging. So you've got this downside risk that after the 90 days, if we do have material downside in the economic outlook emerge, the equity market is very unprepared for that. And we do have to acknowledge that that is a remote risk, that we are due for some sort of economic downdraft as a result of this disruption. But in the interim, we don't know that. And until we do have much better visibility, the default direction for stocks is just to follow the momentum.
Speaking of momentum, we just got about 30, 40 seconds here, Gina. You've got some research out that says the U.S. lags the world in returning to stocks pre-tariff peaks. Is that significant?
I think it is. I think it's really interesting that the U.S. has trailed the rest of the world in this recovery process. Until last week, the U.S.'s high beta status really didn't give it a whole lot of benefit in the rebound, which is very interesting that emerging markets, for example, have erased all of their declines affiliated with Liberation Day. Developed markets outside the U.S. are also clawing back their losses much faster than the U.S. So it is at least somewhat clear that the market is voting that the U.S. is still experiencing the greatest downside risk as a result of this new tariff environment. And that does seem to be quite rational considering how the tariffs are structured.
Yeah, it just makes it kind of even more interesting as we look at kind of this backdrop. Gina Martin Adams, the best, Chief Equity Strategist at Bloomberg Intelligence. This is Bloomberg.
It's 2:21 on Wall Street. We do check markets all day long here at Bloomberg. We've got just about 24 minutes to go until Michael McKee's sit down with Atlanta Fed President Raphael Bostic. The Dow holding onto a gain right now. We've got the S&P and NASDAQ both in the red. 10-point drop right now on the S&P at 59.47, giving up earlier gains down 0.2%. Got to keep in mind that at the worst level of the morning, we did have the S&P down by 1%. The Dow up 42. That is a gain of 0.1%. NASDAQ down 59, a drop there of 0.3%. 10-year 4.47% with a 2-year 3.97%. Spot gold up $25 the ounce, up by 0.8%. For on-demand news 24 hours a day, subscribe to Bloomberg News Now wherever you get your podcasts. I'm Charlie Pellet. That is a Bloomberg Business Flash.
All right, got it, Charlie. Charlie, keeping us up to date on the market trade on this Monday. One of the things that certainly has been front and center, and that is a call between President Trump earlier today and Russian President Vladimir Putin. Apparently it went on for more than 2 hours. We do have some headlines out of it. Curious to see, though, what our Nick Wadhams has to say about it and what he is hearing about what this means in terms of progress towards ending the Russia-Ukraine war. So let's get to Nick. He is in our Washington, D.C. bureau. He's Bloomberg News national security team leader. Nick, good to check in with you. So what do we know, and does it feel like this is a step forward? It's always hard for me to kind of make sense over what is real progress.
Well, I think it really very much depends on your point of view. The analysts we've been speaking to and folks around the administration suggest that this could not have been a better day for Vladimir Putin. Essentially, what you see if you parse President Trump's truth post that came out of this meeting is he says there's a lot of forward momentum. It was very constructive, and ceasefire talks will start immediately. That goes very much against what European leaders had wanted. They had initially set a deadline for a ceasefire by May 12th, and if that didn't happen, then you would have sanctions. Their argument is, listen, you don't need negotiations for a ceasefire. You just stop shooting the guns, and then you have a ceasefire. But what you see in that truth post is, for one thing, the president does not appear to be putting any pressure on Russia, no mention of sanctions, and then the next thing he says is essentially this is a conversation that has to happen between Russia and Ukraine and no one else, and so he's essentially pulling the U.S. out of that conversation and saying it's up to the two of you. So it really feels like a very positive moment for Vladimir Putin. If he wants to play for time, he just got a really strong signal from President Trump that the U.S. is going to give it to him.
Nick, some additional information coming from IFX. The Kremlin says that Putin and Trump didn't discuss ceasefire timeframe, but they did agree to meet in person in the future. Given what we've heard from the Kremlin and what we've heard from President Trump in the Truth Post, what questions do you still have about this 2-hour conversation?
A lot of big questions. So, okay, no mention of a time frame around a ceasefire. That appears to be a win for Vladimir Putin. This has been an absolute meat grinder of a war, but he does have the personnel and the munitions on his side. So in a war of attrition, if it takes a long time, that's going to be a victory for him. The other question is, how does Ukraine stay in this fight? What does the U.S. do in terms of providing additional weapons, ammunition? I mean, the U.S. has been so crucial and sent over so many weapon systems. So if the Trump administration says we're not going to provide that anymore, we're not going to give you money to buy weapons anymore, what happens to all those U.S. systems once Ukraine uses up all the ammunition that it has? So there's going to be a lot of focus right now around timelines and around, okay, there's going to be a Trump-Putin meeting. When will that happen? Will it happen in June or July or August? Could Putin drag that out? Final question for me is, what happens to this big sanctions bill in Congress? Senator Graham, who's been an ally of the president, says, hey, we've got this big sanctions bill. It's got 80 members of Congress, or 80 senators, Republicans and Democrats alike. Let's do this thing as a way of putting leverage on Putin. Well, what happens to that? Right now, folks we talk to suggest it's dead in the water. Trump is going to have no appetite to sign that into law.
Man, it just feels like back and forth, back and forth, back and forth. So who's going to bring this, Nick, ultimately to an end? I mean, the Vatican is now saying that they'd be interested in, I guess, according to the president, in hosting negotiations to bring about a truce. But seriously, you understand these situations. Who is it that ultimately, is it President Trump that says, let's do it, and can put the pressure on Putin? Who is it that ultimately gets this thing to end?
Well, I mean, it's a great question, and I mean that's what's so interesting about this Truth Social post today, because for so long the president and the folks around him have been saying, you know, listen, Donald Trump is the only person who can bring this to a close. I mean, remember in the campaign he said he would have this thing solved in 24 hours. Now in this post he seems to be saying we're not going to be involved in these conversations. That's going to happen between Ukraine and Russia. So he's sort of bowing out. So then the big question is, okay, well, what does Vladimir Putin want to do? He seems to have no incentives to stop the fighting. So the only way that I mean, at least according to the folks we've been speaking to, the only way you can really get him to sit up and to take notice is for the U.S. to say, we are going to join this sanctions effort and maybe go after oil and really squeeze the Russian economy in a way that the previous rounds of sanctions have not been able to do. Right now, though, it looks like President Trump has no appetite to do that.
All right, Nick, going to have to leave it there. Really appreciate you taking the time and keeping us up to speed. Once again, the Kremlin did say that Trump and Putin didn't discuss ceasefire timeframe. This is coming from IFX. But, Carol, they did say that the president and Vladimir Putin agree to meet in person in the future.
Yeah, so it's like TBD, TBD, TBD. Dates and certainty are what I think investors are looking for. Hey, having said that, that is our macro environment, right? And it's not easy. I think we've heard from a lot of CEOs and leaders of institutions what they are dealing with as they try to run their organizations, make decisions, but with a backdrop that can be changing from minute to minute, hour to hour, as we know. We're also coming off, you know, for leaders who maybe had to deal with the great financial crisis or had to deal with COVID. It's a lot that has been coming at leaders. Curious to see what Brooks Tingle has to say. He is the president and CEO of John Hancock Insurance. It is a unit of the Toronto-based insurance company Manulife, and we do have Brooks joining us from Boston. Before we get into some of your strategies, Brooks, I am curious, you know, what it is like to be running a company in this environment today.
Well, great to be with you, Carol and Tim. And somebody gave me some really good advice on this front around the beginning of the year. We'll say in January. That was if you see something, a headline or something happens that you take note of, you're worried about it, you feel like you want to respond to with some urgency, if you can, wait 45 days. And if in 45 days it's still a pressing matter, then act. Now, I'm being a little bit facetious. As a leader, you can't afford always to do that. But that actually was quite good advice when you think about the day-to-day that we've seen and that we're involved in with headlines and so forth. And honestly, as a CEO of a 163-year-old company, we do try to take the long view, and it's been helpful to do so. But you're certainly right. A lot of activity day to day right now.
Well, Brooks, it does look like, or at least did look like in April, that President Trump was trying to reshape the global economic order and sort of move away from everything that we knew during our lifetimes as economic policy and go back to an economic policy that we haven't seen in this country for many, many decades. Does that still look true in so-called 45 days later?
Well, there's some potential for fundamental shifts. I think it's way too early. I certainly wouldn't try to characterize the president's agenda. I kind of stay clear of the political aspect of it. When I look at what's going on with the economy and the aspects of the economy that affect us the most, obviously markets, interest rates, and so forth, it's still too early to tell. You know, you hear some things that are a bit worrisome long-term about, are there parts of the world that are thinking, is the U.S. still, you know, the currency of choice, the location of choice to invest? Now, I would say, you know, the U.S. economy has been incredibly resilient. You look over the years, you know, Carol, earlier on, you mentioned the global financial crisis, the pandemic, all these things. We've been remarkably resilient. People talk about the amount of debt we have as a country, and I take that seriously. I think we all have to. At the same time, I can recall vividly being in university, 1987, and my economics professor saying, the amount of debt we have is crippling. Interest rates are going to be through the roof in the next decade. So, you know, Tim, I guess I can't really prognosticate on that other than to say I would generally sort of be cautious about sweeping statements about what the past few weeks. In the grand scheme of things, it has been a few weeks, but many of us are paying attention to say, are there lasting shifts resulting from some of these policies.
Well, and just, before I want to get into your vitality program that you guys have been doing, hitting a decade, just real quickly, in terms of interest rates and the interest rate environment, insurance companies do care about that. I don't have to tell you or school you. You understand that. Lower interest rates can make an insurance company's products less attractive. I mean, there's lots of things. Higher rates, also bring with it certainly a different strategy. How are you thinking about the rate environment right now and what seems to be Fed officials increasingly reducing the amount of Fed cuts potentially this year?
That does seem to be the trend. You're right that higher rate environment is generally favorable for our industry. And generally favorable for our clients in the context of our industry. I totally understand and appreciate that higher rates are quite challenging with mortgages, credit card debt, and things like that. So I'm not saying it's all great, but for our industry, higher rates are generally a positive. It does seem as though internally when we look out, I think largely with consensus, we do think rates will be lower a year from now than today, but not anything dramatic or sudden, which frankly. I know I can say as a leader, and certainly in our industry, we generally prefer orderly movement in those things. Like if rates are going to trend down,
right?
Methodical, sort of steady tick down, whether that's 4 cuts of 25 basis points over the coming, number of quarters or what have you. Orderliness and stability will be a good thing, and that seems to be the mindset right now.
We'd all love some stability. Always a good thing. Hey, listen, Brooks, one thing I want to ask you, your Vitality program, 10 years, you guys are hitting an anniversary. It's really about teaching your customers, helping them stay healthier, right? And I think about longevity. Again, this was a big theme at Milken this year. What have you seen as a result of 10 years of doing this and the impact it's had on some of your customers?
Well, thanks for the question, Carol, and I love the call out on longevity. Speaking of the economy, the so-called longevity economy or wellness economy are literally among the fastest growing segments of the economy. We're living at a time where, the average person's going to live for decades in what used to be called retirement, right, after age 65. And everyone is so mindful of wanting to live longer, sure, but not necessarily longer if it doesn't mean healthy. So you're right that as a company, we decided 10 years ago now, just recently we celebrated the 10-year anniversary, that as a life insurance company, we should be investing a great deal in helping Americans live longer, healthier, better lives. And it's turned out to be very timely. It's been very popular. And we've now seen 10 years of data about how we can impact people's lives positively. And I think the lessons are instructive for our country overall, emphasizing prevention. And prevention doesn't always work. My mom never smoked a cigarette in her life, never had a drink in her life, exercised every day, still got lung cancer. So the next thing that we've really been emphasizing is early detection.
Yep.
And there's some amazing early detection tools. So anyways, I could go on about this for a while. I get excited about it, as you know, Carol. But this longevity economy it's a great time for us to be looking at these things.
Totally agree. I totally agree. And prevention and tests, it's something that we've been covering a lot here. Brooks Tingle, come back and talk some more. President and CEO of John Hancock Insurance. This is Bloomberg.
It's 2:40 on Wall Street. We do check markets all day long here at Bloomberg. We are seeing a renewed bout of dip buying today. Stocks well off session lows, with the S&P now lower by 1 point. Have been positive a few minutes ago. At 1 point, though, the S&P was down by more than 1%. Traders looking past Friday's credit downgrade by Moody's ratings. S&P down a point. The Dow up 104 now, up 0.2%. Nasdaq down 0.1%. The 10-year 4.47%, with the 2-year 3.97%. Gold now up $30 the ounce, 32.34 gain there of 1%. And West Texas Intermediate crude oil, little changed right now, up 0.2%, 62.59 a barrel. I'm Charlie Pellet. That is a Bloomberg Business Flash.
All right, Charlie, thanks so much. All right, folks, Charlie getting you up to speed on the trade on this Monday. I keep thinking it's Tuesday, but it's not. It's Monday, Leonard.
You wish it were Tuesday.
It's so nice
This is what's called a 5-day work week, Carol. That's what we have this week. Next week, we're good for 4 days, okay?
I just want to have class outside today. Can we just, move it outside?
It is extremely nice outside in New York.
You know you want to be outside.
Wonder how it is in Amelia Island, Florida.
All right. Okay, I got it. Move along. Okay, in just a couple of minutes, we're going to talk with our Mike McKee, who is actually already sitting down with Raphael Bostic, the president of the Atlanta Fed. They're going to have a conversation. Before that, though, we kind of wanted to be like, all right, what's the backdrop for the Fed right now? So Molly Smith, our economics editor here at Bloomberg News, joining us in studio. Yeah, what is the backdrop as Mike gets ready to have this conversation?
The backdrop is sit around and wait and see what happens. It's just really this.
Well, you were kidding when we walked in, right? It's
no,
wait and see.
I said that kind of facetiously, but also not. This has been the message out of every Fed speaker for the last 2-3 months is we're in wait and see mode. There is heightened uncertainty. We don't know what's going to happen with tariffs, where they ultimately settle. How much is this going to affect inflation and unemployment, and which side of the mandate is going to move further away from target? This is the speech. So we have heard that really just on repeat from so many Fed speakers, including a few today. And I would think that Bostic will probably talk about those things, but also Mike McKee is so talented and will probably push him to maybe say something a little more.
What are they waiting for? What's everybody waiting for?
I think, look, there's been so much chaos with, the rollout of tariff policy right now. And, are we in a pause? Are we not? When these pauses are going to be up, what will the ultimate tariff rates be? Where the rates are right now with China and the U.S., who knows if that stands at the end of the 90 days? And same with the reciprocal tariffs that for all the other countries that are right now in a 90-day pause that we're halfway through.
Right.
That's right now, that's what's keeping so many businesses and consumers on hold of making bigger investment plans and purchases, because who knows, you could maybe wait another month and a half and maybe you'll get a better, rate out of it then. So why would you pay for something right now when that rate could change drastically over the course of the next 45 days?
Molly, I love that you said that coming in, though, but it's just a reminder that every time we have a Fed conversation, really important, or a Fed decision, they are dealing with the data set up to that point in time. And in 24 hours, 48 or a week, it could change dramatically.
Yes, and that's exactly why that they keep saying that they're data dependent and that they don't have to hurry to move policy. I mean, I think what maybe you could interpret as a little bit more moving the needle forward on the conversation today was hearing a few Fed speakers say that this could take still several more months, and maybe an indication of we're going to be on hold through the summer. The New York Fed President John Williams was saying today that they're not going to have the clarity they need come June or July, which are the next two Fed meetings. The one after that would be September.
Right.
And there was another one today who also said it's going to be, who knows, another 3 to 6 months before we know what's going to happen. So that could also, if you look into the tea leaves there, be all right, we're probably going to still be having this conversation through the summer.
One thing we haven't talked about as much in the last 2 weeks that we talked a lot about during April is stagflation, and whether or not people in your world are still concerned that we could be entering a stagflationary environment. Is that still a concern?
Yeah, I think that's totally fair. I mean, the conversation is definitely around low growth and higher inflation. Certainly the pause right now with the China tariffs has brought down the risk of both of those dramatically, but the outlook is still for growth to slow meaningfully from where it was last year and for inflation to be persistently above the Fed's target. So I think that's still fair, but at least right now, the growth concerns have lessened definitely a lot since the pause on China was announced. So we've seen a lot of banks drop their recession calls in the wake of that.
All right, so at least for the moment.
A little bit. Slow down, but not recession.
Wait and see. It's like what
Wait
you tell.
and see?
It's like what you tell a toddler. Let's wait and see. Like toddler, right?
Toddler economy.
Molly Smith, thank you so much. Bloomberg News economics editor. All right, everybody, across platforms here on Bloomberg Radio, TV, YouTube, Bloomberg Originals. We're going to toss it over to our own Michael McKee. Of course, he is economics and international policy correspondent, I should say, Michael McKee. And he is there with Raphael Bostic, the president of the Federal Reserve Bank of Atlanta. Mike, all yours.
Well, thank you very much, Carol, and we'd like to welcome all of those people that Carol just mentioned around the world to Bloomberg and to Amelia Island, where the Atlanta Fed Conference is being held, and a thank you to Raphael Bostic for joining us. You've been on Bloomberg's Odd Lots, and you were on another network this morning, so we're going to stipulate that things are uncertain in the economy, and you don't exactly know where policy is going to be. And let me ask you a couple things in different areas. Monetary policy works through the markets, and I'm not talking about the judgment of market people, but do you think that market rates are essentially where they should be given where your rates are at this point?
Well, that's all. First of all, good to have you here. I'm really always happy to speak on Bloomberg. What I would say is this. The market is trying to process a lot at this point, and where our rates are, I think, are mildly restrictive in the marketplace, trying to get inflation back to our 2% target because it's been too high for too long. I think the rest of it is really about perceptions of risk in the marketplace and uncertainty and the volatility that might be present in the market, I think leads to there being an extra premium on it. And so the market will decide what its price needs to be, but it doesn't surprise me very much that we see it at a higher level relative to the things that we've done with our rate in the last year.
Well, we've got the downgrade now that pushed rates up early this morning and overnight, and then it started to fade back a bit. The same thing that sort of happened after Fitch and S&P did their downgrades. Does it worry you that they are not pricing in more of credit risk to the United States, given that we're no longer AAA?
Well, you'll have to talk to the raters about sort of how they interpret these things. What I would say is this. So much of our economy is based on faith that we will deliver on the things that we say that we've promised for the future. When you start to see the markets waver a little bit, I think people are asking the question, do we still have that same level of faith? I think the sign that rates have started to come back down and the markets are sort of returning back to a normal stasis suggests that they think there is that likelihood moving forward, and we'll just have to see where it goes. I mean, I always want to make sure I understand what the price of credit and debt is, but the markets will make a determination of that on their own.
Well, if they are higher and stay higher as they are right now, does that affect your calculation of what you have to do?
Well, it depends. One of the things that will be interesting to see is how businesses and consumers respond to the environment. What I'll say is, because of the word that you said at the very beginning, uncertainty, we know that many businesses and many families are really holding tight to see sort of how this all sorts out. And we'll just have to see how the changes in pricing in bond markets and other markets translates into different strategies moving forward. I do think the stasis that we have right now is one reason why I think it's appropriate for us to be waiting on our policy as well. And we'll just have to see how this all plays out. I'm hopeful that as we get through the summer, we start to get more clarity on exactly where things are going to settle out in trade policy and other factors.
Well, I know you've got your people working on this, but is it going to be hard, do you think? Do they tell you to separate out tariff effects from just secular movements in both sides of your mandate?
Well, I'm not sure that you can really do it so cleanly. What I would say is, when we talk to businesses, what they tell us is they've got a plan based on a projection of where things would be. Tariffs have evolved over time, and it looks like some of those levels are going to be higher, and we have to just see what they decide needs to change in those plans. Today, they're telling us that if tariffs don't get too high, that they can sustain with the level of employment that they have, and they don't necessarily will have to turn to laying people off. But they say, we don't know, and so we're going to wait and we're just going to watch. And on the inflationary side as well, all the models say that the level of inflation that we have is going to be upward, put upward pressure on prices. So we're just going to have to see what the negotiations turn out to be, and then at that point we'll have a better sense of how much we're going to have to do on our side to keep both the employment mandate and the stable prices mandate close to our targets.
Well, you said this morning you thought it would be 3 to 6 months before you get clarity. Does that mean that any kind of Fed action is going to be off the table until at least September?
Well, okay, there's a if and then a then. I would say, look, if it takes negotiations a longer time to settle things out. We have another 90 days on China, for example. That starts to push much further into the summer, in which case we won't actually know what the true effects are going to be for several months after that. If that's how it plays out, then sure, I think, and right now I would say in my SEP I have one cut only for this year because I think this is going to take longer to resolve than it might have otherwise. But things could go faster. It could be the case that these negotiations bear a lot of fruit. We know what the numbers are, and they perhaps come in lower than people are expecting. In that case, we may be able to pull forward some of our actions because there may not be as much that we need to do in terms of managing the price level.
Well, I know it's a surprise that the president keeps changing his mind about tariffs. So what does clarity look like to you?
So for me, I would say where clarity is where businesses feel like they know what the lay of the land is, what the rules of the road are likely to be, and are making plans and moving forward based on that. When I talk to a lot of folks, when I go talk to chambers of commerce and the like, I always ask the question, how many people here think that the rules we have today are the rules we're going to have a month from now? And no hands go up. That, to me, says we don't have clarity. What I would look for is at some point, all the hands to go up, and then I know and I'll have some confidence that when they tell me what they're going to do with their workforce, when they tell me what they're going to do with their pricing, that's actually what will turn out. And at that point, then I'll have a much better sense. I can come back with my team. We can figure out exactly what we think an appropriate path to policy would be, and then we'll move forward with that.
Well, given that no hands are going up at this point, when we get an SEP from the Fed or a dot plot or your argument for one cut this year, should we take any of that seriously?
Well, you take it as seriously as you want. I say, like, for most times, actually whenever I do the SEP, it's a point in time. It has a narrative about where I think the economy is going to go. If the economy goes that way, then that's exactly what we'll do. If it doesn't, then I'll pivot to something else. I think that's really the way to look at it, but also recognize that in the SCP submissions, there's a whole narrative in the back that most people don't pay attention to, which tries to describe some of the things that are embedded in the narrative. And I think those narratives will be particularly important moving forward to determine how much to take on board as to an expectation about where our policy will go.
Speaking of unemployment, the chairman put out a memo on Friday saying that the system was going to cut 10% of its workforce. How is that going to affect the Atlanta Fed, and what kind of divisions are affected?
Well, I would say we are always looking for ways to find efficiency, and when I took this job, I was committed to making sure that we use our resources in the most efficient way possible. We don't have a formal plan right now. The chair just announced this on Friday. I'm talking with my colleagues across the system. We've always been thinking about ways to do efficiencies, and we'll come up with a plan moving forward. But this is something that, look, businesses come on Bloomberg all the time and tell you that where they're going to restructure. I would look at this not as anything different than that.
Is this in any way a response to the Doge cuts that are going through Washington?
Well, this is the chair's directive. You'll have to talk to him about that. I would say I've been having discussions about efficiencies in our bank and in the system for pretty much the whole time I've been here. And I'm looking forward to the discussions to figure out how we're going to do this. I would also say, look, the 10% number is going to be moved on in a number of different ways. So our annual attrition rate is about 8%. So we're going to take our time. We want to do this in a strategic and intentional way so that we don't degrade our capabilities as we adjust our workforce level.
Another subject, the framework review. the chair said last week at the conference in Washington that the shortfall idea maybe didn't work as well as you thought. Are you assuming that that's going to go away in the new framework?
So I don't know about that. I think for me, one thing that I think would be quite positive, and the chair said this as well, is that our framework statement has to apply in a broad set of economic contexts. When we did the last one, there was a belief, I think, that was widely held that inflation was going to be lower as a baseline, and that we would be close to the effective zero bound as our steady state. And it turned out that wasn't the case. So I would look for adjustments that allow actually everybody in the public to see the framework and be able to apply it in a way that works for whatever circumstance arises.
One last question, and to steal a bit from a panel that's going to be here tomorrow. As you look at the framework, you're talking about the policy, the way you look at policy, but what about an operational change, like to demand-driven reserve levels as opposed to ample reserve, something broader for the Fed?
Well, that's going to be a much larger discussion, and I think the chair has said pretty clearly he wanted to really focus on the things we're focusing on. How are we talking about our addressing both the inflation approach and the employment approach to make sure that there was clarity on that. I expect in the years to come, we'll have a lot more conversation about ample versus other types of reserve regimes to implement our policy.
Thank you very much, Raphael Bostic from the Atlanta Fed. Thanks for joining us today. Send it back to you, Carol and Tim.
All right, so appreciate it. Our Michael McKee there with the president of the Atlanta Fed, Raphael Bostic. Just to rehash some of the headlines coming out of that interview, Fed's President Bostic saying the policy is mildly restrictive. He also sees one interest rate cut this year, which mirrors some comments he made earlier today. He said that the Fed could pull forward some of its actions if negotiations pick up. The Atlanta Fed will also take its time in its staff reduction plan. This is something that Bloomberg, I believe, first reported an internal memo. I think it was seen by Reuters, but also directing the Fed Chair Jay Powell to talk about cutting back some of the Fed personnel. Which would be
Roughly 2,500 employees, according to our reporting that we came out with on Friday. We spoke to Mike on that day about this, Carol. The big picture, though, that I think narrative emerging right now is, when is the Fed going to move on the rates path? And we're hearing more and more that it's looking really that they're going to be holding rates until at least September. Yeah, I was just looking at the, the Fed FOMC function on the Bloomberg terminal. So the next meeting is mid-June, June 18th, and you've got one on July 30th. I was curious about that 90-day pause in tariffs that the president has enacted, and that expires on July 31st of this year. And then you get into the fall or close to the fall, September 17th. Don't forget Jackson Hole. Yeah, we'll see. This could be a really... No policy meeting in August, but Mike will put on the cowboy boots, cowboy hat, and he'll head to Jackson Hole. But it's always good, right, in terms of tone and tenor, in terms of what we get from Fed officials about what's top of mind, where they maybe see Fed policy going. We should point out that two Fed officials now, including New York Fed Chief John Williams, have suggested policymakers may not be ready to lower interest rates before September as they kind of look at this murky economic outlook. Second, of course, being Atlanta Fed President Raphael Bostic. But multiple have kind of said and emphasized this wait-and-see approach, which is something that Molly Smith, our economics editor here at Bloomberg News, said that is kind of the narrative that we that's kind of going to be officials. Maybe it'll be the theme of the summer, Carol. Yeah, wait and see. Wait and see. Waiting and seeing. We get some earnings also coming this week. Let's not forget from the retail sector. And then you got NVIDIA next week. So just some things that are still on our calendar. May 28th, mark it down. Yeah. That's NVIDIA, May 28th. Wrapping up earnings season. As we head to wrap up this first hour of Bloomberg Business Week, S&P call it flat on the day. NASDAQ 100 too, just down about 12 points for those watching on TV. The close is coming your way. Tim and I continuing on Bloomberg Business Week Daily.
CBS News on the Hour, sponsored by O'Reilly Auto Parts.
I'm Cammie McCormick. President Trump spoke to Russia's president today about ending the war in Ukraine, but as Stacey Lynn reports, Trump appears to be leaving it up to them to continue the negotiations.
He spoke with President Putin by phone for over 2 hours, describing the call as excellent. After the talks, Putin told Russian media they were ready to continue discussing an end to the fighting, but he indicated there was no major breakthrough in what he termed a very informative and very frank conversation. He said they need to find compromises that would suit all parties. President Trump says he also spoke today with Ukrainian President Zelensky and other European leaders after he had grown frustrated with both sides over the continuing war. Stacey Lynn, CBS News, the White House.
We heard today from former President Biden after his diagnosis of aggressive prostate cancer. CBS's Natalie Brand.
Former President Biden posted on social media a picture of himself and the former First Lady, writing, "Cancer touches us all. Like so many of you, Jill and I have learned that we are strongest in the broken places. Thank you for lifting us up with love and support."
Israel allowed aid into Gaza today for the first time since the ceasefire collapsed. Etan Bartal of Israel's foreign ministry.
The purpose of the aid is to help the population, not to support Hamas.
Only 5 trucks were allowed in. That number was 600 a day before March. VA-funded research conducted at Harvard has become a casualty of the administration's decision to cancel billions in federal grants. Christopher Cruz says that.
The VA and Harvard have been working to develop a program that helps VA emergency room doctors decide if they should hospitalize suicidal veterans. In emails reviewed by the New York Times, a VA research official says canceling the contract would result in, quote, more veteran suicides that could have been prevented. That official asked the agency's leaders to reverse their decision to cancel the contract, but an advisor to the VA secretary said the research could be done at other institutions.
There is a massive cleanup ahead after severe storms in eastern Kentucky. Tina Carnes has devoted herself to helping others. Now her home is gone after a tornado.
It's done a 180 on me. Yeah, so I need help right now. I've lost everything.
Jim Crisula has more on a wildfire in eastern Arizona.
The fire has destroyed several homes and buildings, prompted evacuations and closed major roads.
I feel sorry for the people who have to evacuate. We packed up. We're ready to go if they come and tell us to leave.
The cause of the out-of-control wildfire that started a week ago is unknown.
Checking the numbers on Wall Street, the Dow Jones Industrials currently up 93 points. This is CBS News. A survey of economists shows growing concerns about a possible recession. Here's Peter King.
The National Association of Business Economists poll shows more economists expect a summer of more layoffs and less new hiring.
It gives us a feeling of basically uncertainty of what we can expect in the next 3 months.
NABE survey analyst Lester Jones says higher costs give the illusion of higher sales income, but economists expect profit margins to go down and inflation is not abating. Jones says that all adds up to a possible recession.
40% of respondents placed the probability of a U.S. recession between 25 and 50%.
Peter King, CBS News.
Spain's government has ordered Airbnb to block more than 65,000 holiday listings on its platform. Spain says many of those listings fail to identify who the property owners are. Spain's suffering from a housing affordability crisis that spurred crackdowns on short-term rentals. I'm Cammie McCormick, CBS News.
This is Bloomberg Business Week Daily, reporting from the magazine that helps global leaders stay ahead, with insight on the people, companies, and trends shaping today's complex economy, plus global business, finance, and tech news as it happens. Bloomberg Business Week Daily with Carol Masser and Tim Stenivek, live on Bloomberg Radio, television, YouTube, and Bloomberg Originals.
All right, everybody, we are just about 55 minutes away from the closing bell on this Monday. Yes, I keep thinking it's Tuesday, but folks, it's not. It is Monday, May 19th.
But next week, you will have a 4-day week.
Yeah. Not that,
last week
not that we're counting.
Last week, you only worked 3 days. Not that I'm counting. But welcome back. 4-day weekend. I like it.
A kid graduating, moving her out of an apartment, doing all of that, and then taking 9 hours to get here last night.
How much packing did you have to do, or was she all packed up?
She's actually a pretty organized kid. She was really good, except there was some things. I mean,
you were lucky. My parents have stories about me. It was not pretty.
I could just see.
It was not good.
My daughter, in some cases, would be like, here's what I really care about. I don't care about the other stuff. I'm like, no, we paid for that stuff. You're going to take it with you.
Love it. That's great.
All right.
Welcome back. Stuff. It's good to have you back.
It's good to be It's good to be back. Having said that, we're kind of watching the markets. Muted reaction when you look at the equity side of things, watching the Treasury trade, but curious what our Michael McKenzie has to say about all of that and with that downgrade late Friday.
Yeah, he's got his eye on the bond market and what bond traders are doing. Also, what is up with AI at Apple?
Don't ask Siri, because they're not going to have an answer.
No, it's the subject of today's Big Take. Mark Gurman is going to be joining us in just a few minutes.
Yeah, and speaking of AI, we've got a $61 billion company that's pitching itself as the ethical AI alternative. You're going to love this one. It's a little bit later on in the 4 o'clock hour.
All that and more coming up over the next 2 hours right here on Bloomberg Business Week Daily. First up, though, a check of the day's trade and top business stories. Here he is, Charlie Bell.
Hi, thank you very much. And here's what's going on. We got 54 minutes to go ahead of the closing bell on this Monday. The Dow higher right now, right to the numbers. Dow Industrials up 98. That is a gain of 0.2%. The S&P 500 index just about flat on the day, down by 2 points right now. Keep in mind, have been down roughly 1%. We've got NASDAQ down 26, drop there of 0.1%. 10-year at 4.46%. The 2-year 3.97%. Gold up $30 the ounce. Spot gold up 1% right now. West Texas Intermediate crude down 0.1%, 62.42 a barrel on crude. Atlanta Fed President Raphael Bostic just wrapping up that wide-ranging interview with our Michael McKee. Bostic telling us he sees one interest rate cut this year.
I do think the stasis that we have right now is one reason why I think it's appropriate for us to be waiting on our policy as well. And we'll just have to see how this all plays out. I'm hopeful that as we get through the summer, we start to get more clarity on exactly where things are going to settle out in trade policy and other factors.
Atlanta Fed President Raphael Bostic, interviewed by our Michael McKee, right here on Bloomberg Radio. Nippon Steel plans to invest $14 billion in United States Steel Corp. if the Trump administration approves the merger of the companies. This, according to Reuters. ADRs of Nippon Steel, they're down 1%. U.S. Steel up by 2.3%. For on-demand news 24 hours a day, subscribe to Bloomberg News now wherever you get your podcasts. I'm Charlie Pellet. That is a Bloomberg Business Flash.
Hey, thanks for that update, Charlie. Do appreciate it. The blow landed late Friday. It was during our program, Bloomberg Business Week.
Were you shocked a little
Daily.
bit?
I was shocked, yeah.
Okay.
Yeah, I mean, it was late in our show. It was close to 5 o'clock. We knew that, this would be a big story over the weekend and on Monday.
Yeah.
The big question is what would happen to the bond market. This we're talking about is Moody's ratings revealing that it had run out of patience and was lowering its credit score on the world's biggest borrower below the top AAA level. Moody's cited a years-long pattern of rising debt and budget deficits, which show no sign of abating and deeply rooted political polarization. We got with us Michael McKenzie. He's Bloomberg News rates reporter. He joins us here in the Bloomberg Interactive Brokers studio. I was watching what was happening with the 30-year. Where it went above 5% today.
Yep, it's come back.
It's come back, yeah.
So
someone
was buying it.
Yeah,
someone bought the dip.
Yields are actually down now.
Yeah.
I'm a little confused. Can you help us out?
Well, the 30-year has been rising for quite a while now. So it's essentially back to levels that we saw in 2023. That was in the aftermath when Fitch had downgraded the US. And then, of course, it was late 2023 when Moody's put the rating on watch, and they've now followed through. So from that point of view, it's not a surprise. I think what's happening here is the biggest story is the budget reconciliation process that's currently going through Congress has unnerved a lot of bond investors. So I was already working on a story a couple of weeks ago, talking to some big investors about this. And what you were hearing from people was none of these spending cuts they're talking about are earmarked. So the bond market's going to look through that. So Moody's managed to just push yields up a little bit more. So we opened up this morning above 5% in 30s. We've come back down, but we're still at elevated levels. And really the issue you're seeing here with the Treasury market is the US this year it's going to be having to refinance or roll over about $8 trillion of debt. The budget deficit's around $2.5 trillion. And this is where Moody's has said, what Moody's told us we already knew, but what Moody's also painted is a picture that's pretty disturbing. And it's one that sort of, what the Congressional Budget Office also has been saying, if you look out 10 years, this is not going to get any better. In fact, it's going to get worse. The US is now already in a position where its interest rate, cost of servicing the interest rate costs is bigger than the defense budget. It's going to become bigger than Social Security. It's going to become the biggest element. And so you essentially say, if you look at the US economy today, about 18% of its revenues are going towards paying interest rate cost. And that's why rates being above 4% across the curve is so damaging for the US.
So, folks will say, listen, we've talked about the problem of the US deficit years ago. It was in every conversation, then it kind of seemed to go away, and we just see it getting bigger and bigger. Others will also say, hey, listen, where else are you going to go? I mean, the size of the U.S. Treasury market, the liquidity that it offers investors. So where else are you really, really going to go? So there's that argument. So are they right, Michael? Like, I do wonder, is there some point where the deficit gets so big, it's going to be problematic for U.S. citizens, right, who aren't going to get certain services? They're going to maybe. Like, is there some point where it does become an issue, or are the other folks saying, where else are you going to go? So
there's an element of that, true, Carol. I mean, but I think the U.S. is reaching it has the ability, it has the exorbitant privilege of being the reserve currency, and there are no alternatives at this point. But you're at a point now where it's going to hurt the economy more and more. And it's
because why?
Because rates will stay higher and more volatile.
Okay.
Because you're going to be rolling over all this. So the Treasury is now issuing more short-term debt.
Right.
Because they got scared in late 2023 when the bond market had a bit of a mini rebellion about them trying to increase 10-year and 30-year issuance. But that means if you're issuing more short-dated debt, you're getting to a point where you're rolling over more on the front end of the curve. That could potentially unnerve investors at some point. So the US has got to get some fiscal discipline. The problem is, of course, it's very politicized. Mm-hmm. And both sides of Congress like spending money and have been able to borrow. And that's what also Moody's pointed out. It's successive administrations. This is a bipartisan problem, and it requires bipartisan solutions.
We've heard about bond vigilantes coming in, and the specter of them has been there for years. We always hear the James Carville quotation about being as powerful as the bond market. Yeah, reincarnated. That's what he wants to be. But we haven't seen them emerge this time around.
We've seen flickers of it. We saw it in April when the tariffs. I think the other problem with this administration at the moment.
That's when the bond market got a little yippy.
Yeah, because the dollar's been weakening. And so you're seeing foreign investors who've made a lot of money over the last 10 years owning US assets, equities, credit, and also treasuries, have been rebalancing. The problem with this, of course, is if this rebalancing continues to become something bigger, I do think when you do talk to a lot of bond investors, they don't like the 30-year part of the curve. Mm-hmm. It's just too much duration, and ultimately you're going to have a steeper yield curve as a result.
I mean, we've seen the dollar come way down, right? If I look at just even the dollar index.
It began the year very, very richly valued, as did US equities. So you can make an argument if you're sitting offshore and you've had a really good run investing in US assets for the past decade, you should be rebalancing. It's probably time to rotate into other markets. So it could be just a rebalancing. But if you look at the numbers, the US debt numbers, the debt servicing costs, this is alarming. And I don't think anyone in Washington really, they just don't seem to be that concerned. So it's going to require a bond market vigilantism, flexing of the muscle, to kind of snap everyone's attention.
I love that you went there because I keep trying to make sense out of stuff that was at Milken this year of a lot of really smart investment professionals managing trillions of dollars saying, hey, listen, it's a rebalancing when you see investors start to look at Europe and elsewhere because they became overexposed to the U.S. market. And that's what's going on. I'm trying to make sense of, is that what's going on or is it also some concern over the U.S. fiscal position, the U.S. economic position going forward, and whether or not it's going to be different, and so you don't want to have as much exposure to the U.S. or maybe it's a little bit of both.
I think it's a question of both. It's also a question of this, this administration with its tariff and trying to rework the global trading system. That's a big problem too for investor sentiment. That's really unnerved people. And again, you've got a weaker dollar when rates are going higher in the U.S. That's kind of strange, and that's a signal that people are shedding U.S. dollar assets.
I want to ask you, forgive me, I'm going to jump in.
Yeah, okay, I know.
Why should Americans care about a high U.S. fiscal deficit? Why should they care about higher rates
I'll give you one.
along the curve?
It means that tough spending choices are coming down the pipe, and it's going to be entitlements. And that's going to affect all Americans who are currently putting away money in Social Security down the road. The other factor here is that the most important interest rate for Americans generally is that 30-year fixed mortgage rate. That is now currently at a very high level. And that is directly influenced by the 10-year Treasury yield because most mortgages in America typically get refinanced on a 10-year basis. If the 10-year yield remains in that 4.5% to 5% range, possibly even higher, you're not going to get a refinancing of your home loan anytime soon. More importantly, as people like Jeffrey Gunlick have pointed out, if we do go into another recession at some point, and you can never rule that out, then the budget deficit is going to get even worse because tax revenues will decline and spending will go up because more people will be filing for unemployment insurance and things like that. Which means he argues that you could actually see 10-year and 30-year yields go even higher because the deficit will get worse. So instead of coming down like they normally do in a recession, the long end of the curve won't. And if that 10-year remains stuck, you're not going to get that big, juicy refinancing of home loan that you normally get when you get a recession. So it does matter. It's really important. And unfortunately, one of the people I spoke to with the story said, most Americans don't probably understand or realize that the interest rate cost is now exceeding the defense budget.
Yeah.
They should.
All of that. If you missed any of it, go back and check out our podcast because that's kind of why you should care. Not even kind of, it's why you should care.
And listen to, also read Michael McKenzie's story. It's on the Bloomberg Terminal and also at Bloomberg.com. Michael McKenzie, he's Bloomberg News rates reporter. He joined us here in the studio. Up next, it's today's big take. It's one of the most read stories on the Bloomberg Terminal about Apple has gotten it so wrong with AI. Mark Gurman, next.
It's 3:21 on Wall Street. We do check markets all day long here at Bloomberg. We've got 39 minutes to go ahead of the closing bell. The Dow higher, S&P, NASDAQ, they are both lower right now. S&P down 8, drop there of 0.1%. We've got NASDAQ down 46, decline there of 0.2%. But the Dow holding on to a gain of 0.1% right now, up 57. 10-year yield at 4.45% with the 2-year 3.96%. Gold up $30 the ounce, up by about 1%. West Texas Intermediate crude 62.46 a barrel. Little change right now, down under 0.1%. And this Bloomberg Business Flash is brought to you by ShipStation. Calm the chaos with the shipping software that delivers. Use code Bloomberg for a free trial at ShipStation.com. That's ShipStation.com with the code Bloomberg. J.P. Morgan Chase CEO Jamie Dimon is warning against complacency, citing risks such as inflation, credit spreads, and geopolitics.
I never believed we were as exceptional as people were saying. I never believed that Europe was as bad as people were saying. America's asset price, I still think they're kind of high. I'd put that in the risk category too. And credit spreads are kind of low. I'd put that in the risk category too. I think both of those things may change.
And speaking of J.P. Morgan's investment day, he also said that he expects investment banking fees to fall, but markets revenue to rise amid market volatility and uncertainty around trade policy and tariffs. Again, recapping, S&P now lower by 6, down by about 0.1%. And among tech names, Apple shares right now down 1.4%. I'm Charlie Pellet. That is a Bloomberg Business Flash.
Hey, thanks so much for that update, Charlie. Do appreciate it. It is today's big take. It's one of the most read stories on the Bloomberg terminal. It features exclusive interviews with Apple insiders about how Apple has been falling short when it comes to cracking AI. Here's how one senior member of Apple's AI team put it to our team. This is a crisis. And yes, that is a quote. Mark Gurman is Bloomberg News managing editor for Global Consumer Tech. He joins us here in the Bloomberg Interactive Brokers studio. Mark, I was struck by this, just at the beginning of your piece, there's a picture of Phil Schiller introducing Siri back in 2011, and there are these thought bubbles. And it says, will it rain in Cupertino? What's the weather like today? Do I need an umbrella today? I was shocked to look at the small print and see that was from 2011, because in my view, that's kind of what Siri still does.
Yeah. Siri.
That's the problem.
That is a problem. Siri was revolutionary 15 years ago. It was amazing for its first couple of years because let's see, how do I want to say this? It wasn't great, but it was still amazing and futuristic and sci-fi and better than everything else. Then Amazon came around, Google came around, Microsoft came around, and they just blew Apple out of the water. The technology is just all legacy technology that they've been using for a long while now. For all intents and purposes, we're not talking about a Siri that's based on the same large language models and foundation model technology that you're seeing from OpenAI and Gemini from Google and, Anthropic, you name it. And so, yeah, they have fallen way to the wayside.
Well, speaking of Google, there was a big hire there from 2018 who was supposed to be the guy who did AI at Apple.
He was supposed to be the guy who did AI at Apple, and he's still the guy who does AI at Apple. That's John Giannandrea. Biggest miss was generative AI. They seem to have not seen this coming, and if they did see it coming, they did little to nothing about it. They really, I'm told, started on the generative AI path after Craig Federighi, the head of software engineering, used ChatGPT to finish some code for a personal project he was working on over the holiday break. They take this little 1-week break at the end of December. He was working on some personal software, as one does, and he figured out the power. Yeah, figured out the power of ChatGPT, and then immediately they set iOS 18 for 2024. This is going to be the big AI release for Apple. From a marketing standpoint, it was. They marketed it really well. AI for the rest of us, just like the computer for the rest of us 40 years ago. And okay,
we're good. Drop a little water.
Tim almost dropped.
When is AI going to fix that?
Yes. Other than the marketing, let's take a step back. In the robotics world, in the humanoid robotics world, the fundamental thing that a humanoid robot has to do is go to your kitchen, pick up a glass of water, and bring it to you without dropping it. Okay. Tim almost dropped his water all over him, so that's where I got the idea to mention this. The problem isn't so much the iPhone and the AI capabilities on today's devices. The problem is can Apple make AI that's good enough to power a robot that's not going to spill their water like Tim, right?
There it is.
And so the worry is not necessarily about the technology today, but it's the technology of tomorrow and a decade from now. And so the iPhone, you know, its reign is going to be over at some point, but that's not really what matters here. I think that's not big picture enough. The big picture is the next set of stuff. We've seen AI already lead to the car cancellation in part. There were many other factors, but if Apple was able to get an L5 car with tip-top AI and great safety features,
Level 5 is what you're referring to.
Yep, they would have brought it to market. So, you know, we've already seen AI cost them one big category. They were supposed to have a big smart home push this year. It's been delayed. It was supposed to happen in March. Now it probably won't happen until the end of this year or next year. The AI not working cost that. Now they're already having trouble coming up with use cases for AirPods and watches with camera and smart glasses with cameras because you need real good AI to use that. So the iPhone doesn't matter. It's everything that comes after it.
So why can't they get this right? Is it personnel? Is it culture? What is it?
Both. It's personnel, mismanagement, it's culture. Apple's wired in a very specific way. I get into it in the story. They're wired they sit down, they map out what they want to do, and then they make the investment to get there. AI sort of works the opposite. You don't know exactly where you're going to land. It's a little bit messier. You have to run a little bit faster. It's a little bit, you know, more expensive to pull off. And so it's just a philosophical product development question, right? And so Apple has to change. AI moves so fast. You know, there's a new AI provider or a major new AI technology on a weekly basis at this point, even more frequently. But Apple's wired to release one major software upgrade every year and a smaller software upgrade in the spring. So they're going to need to move away from that idea as well if they really want to stay at pace with the rest of the technology industry. So AI and Apple, it's just so interesting. It's like putting two magnets next to each other. They're just going to push away, right? And so Apple's going to have to change at a very core level to really be able to make meaningful change and to have meaningful improvement in their Gen AI world.
You know, I'm thinking about this, and Mark, when you talk about Apple, and you know this better than anyone else, people, a common refrain, and I don't think this is true, but it's that Apple stopped innovating after Steve Jobs. And you can go and kind of look at Apple's share price and what has happened with investors and the way that Tim Cook has led the company. The concern that I potentially would have in a situation like this as an observer is this Tim Cook's legacy here? Missing AI?
First of all, I don't agree with the idea that Apple stopped innovating since Steve Jobs.
I agree with that. I agree with you.
No, I know you agree. If you think about it, they've basically haven't innovated or done something wholly new since the iPhone, right? Now, are we really expecting that? I think yes, to some extent, but like you look at it and like the iPad to the iPhone was like the Vision Pro to the iPhone, right? They're both different reincarnations of that same operating system. You put the Apple Watch in that category as well. So you have sort of the central product, the iPhone, and you just kept building and building around it and building it up into new form factors. And they haven't really done an entirely new product experience from the ground up. And so, you know, at some point they'll get there. But right now it's about new form factors. And honestly, I'm not sure anyone would have done a better job than Tim Cook over the last 15 years or so since Steve Jobs passed away. So certainly could have they done a lot better? Yes, but they've also could have done much, much, much worse.
I want to ask you, does any of this matter? Because you write in the story, being late to a potentially world-changing advance isn't necessarily catastrophic for Apple. But there are risks of being late, too.
Well, it's not catastrophic for Apple because being late implies that they're going to get there. And so, you know, as long as they're late, it's not catastrophic. But they're going to need to get there because, like I said, they're going to miss so many upcoming technological waves if they don't master this. I said this to someone I was on the radio with earlier, and they were a little surprised, but think about it for a minute. You're going to agree with me. AI is as core of a technology as the touchscreen, right? That's a big, bold claim, right? So Apple is known for taking core technologies and pushing them to new form factors. And so multi-touch touchscreen, that's the type of touchscreen that lets you do multiple gestures at once, lets you do the pinch and the swipe.
Yeah.
That's called multi-touch. That was a core technology that allowed them to build the iPhone and the iPad. All their Macs and iPads and whatever they're releasing these days, the core technology at the heart of that are their chips, their in-house processor design. AI is the core technology that's going to enable robots to glasses to maybe they'll look at cars again in the future. Who knows? It's not something they're looking at right now, to be clear. And so they need to master that core technology to get to the next era of hardware. Apple's a hardware company, right? And if they want to continue making the money they're making, they're going to need to do new hardware. And the way to do new hardware is to come up with new core technologies.
But they hired this guy in
You even printed it out. I love it.
Oh, yeah, we print out everything.
Are you kidding? But they hired this guy back in 2018.
Yes.
So it's almost a decade.
Yeah,
Not quite, but getting close.
You're right, and that's unbelievable. But yeah, we're close to a decade since he's been there. You're right.
All right. So from someone who knows this company so well, I mean, how are you thinking about, or who are you watching, or what are you watching internally? I mean, the company obviously listen to you. They listen to others have conversations saying, where are you, Apple, when it comes to AI?
John Giannandrea, JG as he goes by, I don't think he's long for Apple.
Is that good?
I'm not going to opine on whether it's good enough for a person to no longer be at a company, but I'll put it this way. They've already stripped him of all product-related responsibility. They removed Siri from him.
Right.
They removed robotics from him. They're going to probably remove some more things from him. They want to squish him down to a role that's entirely focused on large language model and core AI technology research, which he's really good at. And so, I mean, if they're taking away 75% of your remit, you know, you may decide that the writing's on the wall, it's time to get out of here. I don't think it's going to happen imminently. I don't think he wants it to happen, but I think at some point a change will be made, whether it's because he decided or because Apple forced his hand. But I don't expect them to fire him. Apple doesn't do that for senior executives of that level unless you really do something bad. And for all intents and purposes, JG's a great guy. He's very well liked. He's very respected in the machine learning and AI community.
Can he get them to where they need to be?
He can be a piece of that puzzle. Don't forget, Apple is constructed by a functional model. So you have design teams, you have hardware engineering teams, you have software engineering teams that bring together the product at the end of the day. If you dilute JG to only focus on AI research, but you have other people in charge of like AI product development, I think it's possible that that's a winning formula. But clearly, him running all of AI was not a good formula.
We only have 30 seconds left. Could Apple acquire its way out of this? They've partnered with ChatGPT, OpenAI.
Well, first of all, yes, they need to acquire as much AI talent as possible. But that's also another cultural issue where they have this cultural allergy to integrate large-scale companies. The Beats acquisition, internally, disaster. The Intel modem acquisition for $1 billion in 2019, disaster. They just have a terrible track record of taking these humongous companies and pulling them into Apple. So, you know, it's a cultural thing through and through that they need to make some shifts on. But if they resolve all that, they bring in the right people, they make the right cultural changes, it's Apple. They've got the brand, they've got the button, they've got it all.
Gotta say, I was in the car, I was doing a lot of things over the weekend, talking to Siri. I'm like, you're not bringing it, buddy.
You're not bringing it.
The worst thing for Siri for me, I'll keep this real quick, is like I like go to sushi restaurants. I'll say a sushi restaurant, and Siri asks how to get there. Okay, and then it takes me to the Japanese city the restaurant is named after in Japan. Why would you take me somewhere 6,000 miles?
It's 3:40 on Wall Street. We do check markets all day long here at Bloomberg. We've got 20 minutes to go ahead of the closing bell. With the Dow higher, the S&P, NASDAQ, they are both lower right now. Let's head right over to the first word breaking news desk for today's afternoon call. Here he is, Bill Maloney.
And good afternoon, Charlie. U.S. stocks are quiet right now, overcoming a weak start after Moody's downgraded the U.S. Friday. Dow was down 317 points, is now higher by 80. S&P is still down 6, and NASDAQ is lower by 40. The U.S. 10-year yield is at 4.46%. Gold is in the green. Oil is little change, but Bitcoin, that's higher by 0.5%. Leaders to the upside in the Dow, UNH and Merck, while Nike fell 1.8% and led to the downside. Among the main 11 S&P sectors, leaders were healthcare and the industrials. Energy was under pressure. And on the geopolitical front, Trump said that Russia and Ukraine will start ceasefire talks immediately. Among the financials, J.P. Morgan fell intraday after seeing investment banking fees down mid-teens in the second quarter. And wrapping things up, UNH gained 7% and closed the May 15th sell-off gap. Live from the first breaking news desk, I'm Bill Maloney. Charlie?
Okay, we thank you very much, Bill Maloney, to hear live breaking news over your Bloomberg. Type SQUAWK, S-Q-U-A, on your Bloomberg channel. I'm Charlie Pellet. That is a Bloomberg Business Flash.
I'm driving in my car.
How about you let me drive?
Oh, no. This is not a toy. Who's gonna drive you home? Honey, please, I'll do the driving. Drive on. Excuse me, I want to drive.
It's the question that drives us.
This is the drive to the close.
That funky music will drive us till the dawn.
On Bloomberg Radio.
All right, TikTok, everybody.
Send someone for Carol. That's what I'm going to say.
What do you mean?
No, you're good. Summer Carol. This is what I like.
I know. Well, you know.
Fresh from a big graduation. Congratulations.
Couple days off.
Yeah.
It's always good, right?
A visit to a historic part of the country.
I know. And I'm really into the historic parts of our country. I don't know. It's like getting back to our roots, kind of understanding it. What?
You should have bought the meme coin, so you could have made a visit to. Well, it was going to be the White House, but
no,
because you're not one of the top holders.
I don't know that
so
I
then,
could have afforded it.
No, it was yeah, it was a lot of.
Yeah,
you would have to. But you could have sold ahead of. You could have sold.
How much was it?
I don't know how much the coins went for, but I mean these were the top holders. Or I don't know how much the purses were. I guess I should say, or the wallets. I did not.
Yeah.
No, we're not allowed to do that here.
Remember the whole security issue of like who's going to be? Because
still an issue.
They don't know who it is.
Still an issue.
All right, let's talk about the markets a little bit, because still an issue is kind of where we go from here. But having said that, investors seem to be shrugging off certainly the downgrade by Moody's on Friday. Let's get into it. Ryan Dietrich is back with us. Great to have with us, Chief Market Strategist with the Carson Group, joining us. Ryan, it is good to have you here with us. How do you, we've talked to you, we always give you props about the last couple of years, really getting your market calls right. It does feel like we're in a wait-and-see mode, whether it comes to Fed action, what we get on tariffs. Where are you on the markets right now?
Yeah, Carol and Tim, thanks for me back. I looked, last time I was on with you was April 10th, right? So that was the day after that huge rally. We sold off pretty hard, and we talked then about the idea that we could be due for a pretty big bounce. Now, I didn't think it'd be quite like this, but it's where we are. So, Carol, last week, if you were running around, missed it, we had a big up day on Monday, up 3%. Then the next 4 days, all were green. And I said, that's pretty rare, because usually if a big up Monday, usually you give some back. We didn't last week. March of 2003 is the only time we saw a week like last week. And that was actually the lows of really the bear market, if you will, from the tech bubble. And the war started in Iraq, and then they were off to the races. I get it, sample size of 1, but what we've been saying for a while now, the lows are in. I know it's pretty obvious now, but we were saying that 4 weeks ago that lows were probably in, and we still think, this market wants to go higher, and we're listening to it.
Why does it want to go higher right now? I think that's still a lot of people who have looked at, the 20% increase that we've seen off those April 8th lows are saying, wait a second, we didn't necessarily get something fundamental shift except for this pause.
Yeah. Tim, that's a great question there. And listen, I think it's all about expectations. I mean, what was being priced into the market this time 5-6 weeks ago was just, almost, I'd say the end of the world. But that's the way people felt like they were talking. And you see it. And then, no, that's not the case. We just had a really solid earnings season, right? I know the consumer's not perfect. We get it. But the consumer's still okay. The labor market's still solid. All these things are why we say it was like a beach ball under the water. You release it, it goes up. Here's one thing to think about. Since starting on March 9th, they're at 27 trading days. The S&P's up, like we just said, nearly 20%, right over 19%. if you go back in history, other times we saw that much strength in only 27 trading days. You're talking off the lows in 74, the lows in 82, the lows in 2009, the lows off of 2020, and now. I mean, those were not the worst times to think, you know what, the market is telling us something, and we're just hoping a lot of people are paying attention, because those were pretty solid times, and that blast of strength we've seen is not a short covering rally. It's not a bear market rally. It is kicking off again, in our opinion, another, a continuation, I guess we'll say, of honestly this bull market has been in place since October 2022.
So many things I want to come back at you with, Ryan.
Yeah.
Having said that, we talked with our Gina Martin-Adams, our chief equity strategist here at Bloomberg Intelligence, and she reminded us, put out some research, and she says, however, while U.S. equities have been a key beneficiary of de-escalating tensions, they continue to lag major global markets in the rebound toward pre-tariff Liberation Day highs. So even though the bounce back when you go outside the United States has even been better.
No, shout out to Gina. She's awesome, obviously.
She is.
And that's true. You know, in the money that we run for our Carson partners, I've come on with you guys for a while, for a couple of years, saying we like the U.S. We like the U.S. Honestly, starting earlier this year, we've kind of taken, we're still in U.S., yes, don't get me wrong, but we have some exposure to developed international, specifically Europe. I mean, when we saw Germany break out the fiscal bazooka a couple of months ago, we said, wow, there's something going on here. So, yes, diversification used to be a dirty word. Diversification always used to having to say you were sorry. Then you have a year like this where it's like, wow, I guess a lot of investors are glad you're diversified, because if you have global portfolio, you're up nicely this year, right? If you're all in Mag 7, all in US, we get it. I guess you're positive kind of now, but it sure was a long trip to get there. So listen, when you're uncertain, diversification really can work, and that's a nice way investors need to remember that.
Yeah, I mean, you're positive for the year as long as you didn't sell. I'm kind of saying under my breath.
Well,
Ryan.
True. No, I totally agree. And again, we came into this year in our outlook that we put out, in January earlier this year. Yes, we were bullish. Yes, we were optimistic. We said there could be a 12 to 15% peak to trough correction because we hadn't had one in a while. By the way, after a 20% gain, the first quarter is usually pretty weak. The first quarter of the last 20 years has been pretty weak. Oh, and post-election years, the first quarter is actually one of the worst quarters out of a 4-year cycle. So all those things stacked up that we could have some indigestion. No, we didn't see a near bear market. No, we didn't see a 10% crash after Liberation Day, but we did see the potential for some volatility, and now just as quickly, obviously, we're on the other side of that, fortunately.
Hey, though, Ryan, is it a peak to trough correction that we just needed because there was too much, fluff in the markets at this point? Or is it, I mean, the trade really reacted to the news out of the White House. It's why we talked about it so much, because you could see clear correlations based on what was coming from the president and his views on tariffs in particular. And the markets reacted. So there was a fundamental basis to it. And if the fundamental basis going forward, especially when it comes to tariffs, is that, yes, indeed, Libby Cantrell of PIMCO, who we talked to earlier, we could potentially still be in a much historically higher tariff environment going forward, and that has implications for markets.
No, there's a lot there. If everybody's thinking alike, somebody isn't thinking. I like to use that quote a lot, General Patton. It sure felt like late last year, everybody was bullish. I mean, these long-term bears were claiming they were bullish all the time. We're looking around as people that were taking a lot of arrows and body shots in 23, early 24 for being bullish, thinking, uh-oh. And I do think we needed that washout. I do think we needed to shake the tree a little bit. There was a little too much froth, up 74, 75% off the October 22 lows. Maybe it was necessary. And I didn't think it'd be, again, 20%. But it's what happened, and that's what shook a lot of those hands out. But you're right. When President Trump won, I mean, what's the phrase? He used this. It's going to be close enough for government work. Tariff, the most beautiful word in the English dictionary. It's not like this was a total surprise. Now, I get it. When he held up that board on Liberation Day, April 2nd, those numbers were higher than we expected. But I'm not sure. I did read Libby's note today. I mean, Libby's awesome also. The reality is I think markets can live with 10 to 15% tariffs. They couldn't live with what we were seeing a couple months ago, because that's what's being priced in. And then that's kind of where we are. And if they bring all those tariffs back, yeah, we're probably going to go right back down. But I don't think that's the case. I think we're kind of through that. And now, what do we have? We've got deregulation coming, potentially the lower taxes coming. Those are the things also coming the second half of this year. Go ahead.
We're now a little change on the year. What do you see us by end of the year? Do you think we'll be up 5-10%? What's your call? Got 10 seconds here.
Yeah, we came into this year, we said between 10 to 12%. I'll tell you what, I think we're still thinking that's very likely. We got a round trip, but we think it's possible.
Ryan Dietrich, got to run. Chief Market Strategist with the Carson Group, joining us on this Monday. Stick around.
This is Bloomberg Business Week Daily with Carol Massar and Tim Stenovec on Bloomberg Radio.
It is Bloomberg Business Week Daily. That is Carol Massar. I'm Tim Stenovec.
Trying to get my different earbuds.
Is it working?
In place. Oh, this one's
How
got
are you doing?
It's got a knot in it.
Are you okay?
I'm going to have to live with it. Sorry,
Okay,
guys.
that's
there might
okay.
be some wires showing. Hey, sausage being made.
Can we talk a little about the stock buyers wading back in to fuel this bounce from lows? This is the market's wrap.
Yeah.
It's one of the most read stories in the last 60 minutes. A renewed wave of dip buying has fueled a rebound in stocks from session lows. Traders are looking past that U.S. downgrade by Moody's ratings that earlier sent bond yields jumping.
I don't know how I feel about this rally.
Why?
I don't know. I don't know. I know we've bounced back a lot, so we're kind of where we were before we started. But, you know, it was funny. I always think about people saying you can't time the market, but at one point we were up about 10%, right, ahead of the election and going into the election, not
What
the
are you
election,
saying?
going ahead of the inauguration. So
Were you saying that was...
that was kind of a nice, I would have taken that, right? After 2
Oh,
years
you would
of
have
strong hits.
sold.
Yeah, and said, you know what, I'm done for the year. Just saying.
Easy for you to say in
right
hindsight.
Right now.
Call up John Authors with Hindsight Capital Management because...
right now we're little changed.
Yeah, we are a little changed on the year.
And
would you have plowed money back in on April 8th?
Great question. Great question.
You know what we should do?
I do believe in buying when things are beaten up.
We should have like one of those fantasy stock trading things between us.
Oh my God, we should do that.
Let's do that.
What's wrong with
Because
us?
you're super competitive. So, and you always say,
says the super competitive.
and you always say,
Stenovec.
you always say timing the market
You should
isn't
see
that
us do
hard.
quizzes. It's like,
So let's put our money where our mouth
we
is.
should try that and play around. You know, Peter Lynch, I used to remember years ago.
Talk about quitting while you're ahead.
Early in my career. And
A
he used
legend for that.
He used to work with students and like local schools, you know, near Fidelity. And what was interesting is what he loved about kids is he said they'd buy things that they understood, like this kind of concept. I think Warren Buffett did some things like that. Like, I need to understand the business. But playing around with kids who just kind of had a very clear vision of why they would buy it, and I think would tend to do well. And sometimes it would be fun to just play around with like a fantasy portfolio.
Yeah, let's do it.
Right?
Yeah, we'll figure out a way.
Okay.
Hey, in the meantime,
anyway, go ahead.
a New York City story that's getting my attention. Wynn has ditched a New York City casino plan. Wynn Resorts
Really?
dropping out its pursuit in a casino license with related companies in New York. They cited a rezoning process and local opposition that makes the opportunity less attractive.
This is what people say about some of the major cities, right? You hear that with San Francisco and real estate, right? So all of the regulations and things of trying to do things.
I think this is a different animal just because it's a casino.
Fair.
And there are sort of
Totally,
unique
totally.
challenges when it comes to community pushback, but no question. I just read, and I think maybe we'll get them on the program, Abundance by Derek Thompson and Ezra Klein. And a big part of that lack of housing, especially in expensive cities that have been run by Democrats for years, they argue has to do with local opposition and pushback.
It's funny. My husband and I were actually talking about like the casinos coming to New York, and I have mixed feelings about. I mean, I know this is what a lot of major cities do, and maybe it's another thing for when people come to visit New York. I don't know how I personally feel about it.
Yeah, I don't know either.
I don't know. I guess I feel
I
like.
grew up in a town in California where there was a casino.
Was there?
But it's on Native American land.
Okay.
So that's kind of how it was when I was growing up. I feel like New York City just has everything already.
Yeah. Oh, what's
So-
interesting, the companies, I guess, looking to do this faced opposition from local groups, including the Friends of the High Line, the elevated promenade, among the complaints, the casino tower would interfere with views. Hey, listen, that's legit in my view.
Hey, other competitors are forging ahead. The Solviev Group sought to sweeten its pitch with a way for New York City residents to take a stake in the facility. And then last month, Steve Cohen's plan to build an $8 billion casino and entertainment complex in Queens next to Citi Field gained a key vote in Albany. It'll happen.
That kind of makes sense to me. You're out there, there's still stuff going on, there's Citi Field, right? There's just a lot of things.
And he owns the Mets.
And he owns the Mets. So maybe you go see a game, or I don't know, you can make it kind of more of an entertainment complex or something of that sort of thing. I'm just not a gambler. Maybe that's just my own problem. My name is Carol Massar, and I don't know that I like
She knows
gambling.
what she says. She knows how to time the market, but she's not a gambler.
I don't know that, but I find it funny when people say you can't time the market. I'm like, there is a point where you can say, that's a great gain for a year. And just...
But then what if you leave money on the table?
Oh, stop. Stop.
I imagine that's what they...
What if you don't lose a lot of money that goes elsewhere? Anyway, do not go anywhere. We're heading over to our TV colleagues. The gang is back. The closing bell starts right now.
Down of all of today's price actions starts right now with our global simulcast.
Closing Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close starts right now.
And right now, we are 2 minutes away from the end of the trading day. Romaine Bostic here with Alex Steele, taking you through to that closing bell. It's a global simulcast, and it starts right now. Scarlett Fu in the TV studio, Carol Massar and Tim Stenovic together, believe it or not, in the radio booth. All five of us back together here on this Monday afternoon as we welcome our audiences across all of our platforms, including, Carol, our partnership with YouTube.
Yeah, we are across all the platforms. We are everywhere. I kind of find it fascinating that I guess investors are like, yeah, another downgrade. Okay, you know, we kind of maybe thought it was coming, not surprising. And investors, certainly the equity side of things, seem okay with it.
Yeah, I mean, it also seemed to be okay with it on the bond market. You saw some buying on the long end, on the 30-year, when there was concern that, you know, it had gone above 5%. I don't know, maybe everyone's desensitized. I don't know what the answer is.
I think that's a good part of it. I mean, 5.03% on the 30-year earlier today, but you just look at the reactions in the past. In August 2011, when S&P downgraded the U.S., the S&P lost 6.7%. Right. In August 2023, the S&P lost 1.4%, and now we're unchanged.
Well, you have to also wonder, too, like we did hit that 5% level, right, in the 30-year. So if that's really the top, so then you're going to bring in buyers, and that's going to sort of be a self-correcting mechanism.
Yeah, and it gets to this idea, too. I mean, you point out, you know, sort of the big outsized move that we had back in 2011. I mean, that was a shock, right? I don't think anyone really saw that coming. And as a lot of our guests have said on the program today, it's like, look, S&P already did it, Fitch already did it, Moody's, it was kind of like, you know, what took you so long?
Yeah, exactly. Yeah. Meantime, you got Fed officials saying, hey, folks, don't get too excited about rate cuts. Maybe we'll get one this year. We'll see what happens.
All right, well, the market's definitely taking Friday's news in stride here and maybe focusing a little bit more on the progress on that tax bill and some of the other efforts in Washington here to make things a little bit easier for companies. Green across the screen for at least three of the major indices here in the U.S. The Dow Jones Industrial Average up by more than 100 points or 0.3%. The S&P 500 is going to close up by just about 5 points or about 0.1%. The NASDAQ Composite in the green, but we'll call it unchanged, only up about 4 points on the day. Similar move for the NASDAQ 100. Though in the small and mid-cap space, you still did see significant declines on the day. Dow Transport's down 0.3%, and the Russell 2000 down 0.4%, Carol.
All right, Romaine, quick check on the S&P 500, guys. Kind of an even split here when it comes to winners and losers. So you've got, 255 names to the upside gaining ground on this Monday. And Scarlett, 246 to the downside.
All right, let's take a look at the IMAP right now. You've got 7 groups in the green and 4 in the red. Let's start with the gainers here. Healthcare shares up almost 1%. Consumer staples and industrials each gaining about 0.4%. The biggest laggard is energy, losing about 1.5% right now, 1.6%. And in fact, for the year, it is down about 2.2%. We also have some weakness in consumer discretionary and tech as well, but those are more leaning towards unchanged.
All right, guys, so kind of a mixed bag there. Let's get to some of the gainers. There were really some outperformers in the Monday trade. Paramount Group, ticker is PGRE. This one up as much as 20% during the trading session, finishing with a gain of about 13%. It's a REIT. It's a major office landlord. New York City, D.C., also San Francisco, about a $1.1 billion market cap. Surging, as we said, the company's board initiated a review and evaluation of strategic alternatives. Some speculation, might that mean an outright sale of the company? And this is all coming after it named a new CFO and treasurer effective immediately. Keep in mind, Wall Street Journal also making some points about this company's had a lot of red flags or that have been out there in the last few months. And so this company, you know, looking kind of to see what's next here in its next chapter. Take-Two Interactive, outperformer, up about 3.5% in today's session. It was a top gainer in both the S&P and the NASDAQ 100. Did report earnings last week, and we are seeing the analyst community come in and weigh in on those earnings. So analysts raising price targets for the company since it reported earnings. 16 changing price targets. The average change was up 11%. 15 analysts raised price targets by an average of 12%. So some optimism on the street. And Novavax, talk about optimism, up as much as 30% during the session, finishing with a gain of about 15%. U.S. regulators fully approved the company's COVID vaccine, so easing some investors' concerns after the clearance was delayed.
Just in time.
Yeah, exactly. Exactly. Good stuff. So anyway,
well, it's not mRNA, so I think that if you needed different sourcing, that would be something for you.
Yeah. I will say Moderna also an outperformer because maybe there's some, you know, different thinking. I think everybody thought the government was going to be so anti-vaccines, and yet this happens for Novavax, and so investors also plowing into Moderna up about 6% today.
Okay, you got the gainers, Carol. I got the decliners. I do want to just take a look.
You had some trouble here.
Oh, yeah. I just had to do a last-minute switch. But you know what? The team was great. They were able to switch it out for me, so I appreciate that. I want to start with shares of JP Morgan.
Just
taking
imagine,
a look at,
no one would ever have known if Carol had.
I know.
I know.
Yeah.
Isn't, with friends like Carol?
Do I come across like a little sister?
It's
I should.
Killing me. You're killing me. 1% to the downside for JP Morgan. The company did reaffirm its net interest income forecast for the full year. This at an investor day earlier today. Shares fell earlier in the session, though. They hit a session low after an executive at the company said investment banking fees will fall. We also saw peer organizations fall as well. The company's CEO, Jamie Dimon, in a speech did warn against complacency in the face of a slew of risks. He cited everything from inflation and credit spreads to geopolitics. Ultimately, shares fell 1% today. I want to talk about solar stocks, in particular Sunrun, ticker RUN, down 7.8%. Shares of solar companies slumped. This after Republican lawmakers said that they had secured a commitment from leadership to end key clean energy tax credits earlier than planned. It's part of a sweeping deal aimed at allowing President Trump's giant tax and spending package to advance. Sunrun fell by about 7.8%. And finally, shares of Shake Shack, 1.6% to the downside. They fell after TD Cowen cut the recommendation on the company to hold from buy. They cited an already high valuation amid a challenging consumer spending backdrop.
Well, here's the interesting part when it comes to the bond market, guys. I mean, coming into the session, it looked like we were going to see some pretty intense action. The long end was selling off by 6 basis points already. Then we reversed course, and we actually ended with the whole curve lower by about 2 to 3 basis points. I do want to point out, though, that the 30-year yield still hit that 5% level. We hadn't seen that since 2023. And you look at a technical basis, and we're looking at a golden cross, guys. Woohoo! Okay, so the short-term moving average looks to break above the medium-term moving average. So 50-day crosses above the 100-day. That's a golden cross. That tends to be a bullish signal, which means higher yields. And you wonder at some point, are we at that tipping point where yields wind up directly hurting stocks?
Yeah, it's a really good point, right? You kind of wonder where it all goes next. I have no good segue except what?
There's no segue. Just take it because it's awesome.
All right, let's talk about the maker of Dum Dums and.
What?
Yeah.
What did you call me?
That's what I was,
Don't take it.
That's what she calls you when you make a mistake.
Dum Dums. Lollipops.
Oh.
And then you also have, Sweethearts?
From our youth.
Those little candies.
Yeah.
You know what they are. Well, apparently the maker, the CEO of the company, Spangler Candy Company, makes all this good stuff. Apparently kind of pushing back on this idea of switching from synthetic dyes to natural colors. He's worried about the taste and maybe whether consumers will like it as much.
Yeah, take beet juice, for example. It turns out beet juice, it might be a nice red, but guess what? He says it tastes like beets.
Yes.
And that's an issue.
Let me tell you, this guy is a national hero. He should be in charge of HHS. I totally agree with him. Look, if you're going to eat candy, I mean, what it's like when they have, like, upstairs, they have these healthy gummy bears, right? But, like
this is personal, guys.
I mean, it is personal. Like, I mean, I don't eat candy because I'm trying to be healthy.
It's called candy, not vegetables, right?
Yeah, thank you. So, let me get my chemicals.
Also, and didn't they also say, like, it could be dangerous for allergies, too? Like, that was like, here's the made-up stuff. That's fine. But if we give you real things, your allergies could kick in.
Well, so what you're saying is the candy just needs like a warning label. And then everyone's all good with everything, right?
Doesn't it bother you guys that this red dye number 3, which has been linked to cancer, and now they're only going to start phasing it out, I guess, in early 2027 will be banned? Isn't this the stuff that was already banned in makeup? Like, why is it even still there?
But I don't know why. I don't know why you even need
2 years?
I don't know why you need.
Exactly.
Carol Master.
But to Carol's point, I don't know why you need the dye. I mean, if you're eating something that tastes like it's not the flavor that the concern is. That's the concern if they use
Bring
the dye.
on the
But
beet juice.
if it's clear, Crystal Pepsi. Remember Crystal Pepsi? It was so successful.
What?
No.
No, I don't remember
Being
this
totally
at all.
facetious.
No,
yeah.
I know, but I remember that at all.
It was for a hot second in one commercial.
I wonder what Oscar the Grump or Grouch.
Oscar the Grump.
Nice segue,
my
Carol,
goodness.
because it looks like Netflix is making a play for
Carol.
Disney for that children's audience. Did you guys read the story that Netflix will be airing new episodes and old seasons of Sesame Street?
I love this so very much.
For people who've cut the cord completely and don't have PBS anymore, then you can get it now.
But
on
you used to have
Netflix.
HBO. It used to be on HBO. You get all the reruns and the new ones. It was fantastic. That partnership was broken down, so it's so great that you now have a way to get it.
Yeah.
Huge.
Well, and a way to get it. And what I really love about this, too, is that you have a way to get it without paying because they are partnering with PBS on this. So they're actually going to, unlike HBO, which took it off PBS.
I know.
And you had to wait, several months to see a new episode. Netflix isn't doing that.
No.
Yeah, they're going to air when it airs on Netflix. It'll be airing on PBS.
Letter of
So
the Day's
if you
End.
can't afford the, however much it
And for
costs for
what?
Netflix subscriptions, you can just
For
watch
Netflix?
it there, and you can sit there with your dumb lollipop, pineapple to be sure.
Oh, gnarly. You don't like pineapple.
Did you say gnarly?
I did say gnarly. Because pineapple lollipop, what's the point? Just don't even eat it.
Alex, are you into beet juice? Would you like the beet juice?
She would like.
No, I would totally like the beet juice.
I
Yeah,
might.
I like a beet juice, but not with my Dum Dum lollipop. The two should be separate.
I'll do it with you, Carol. It's cool.
All right.
So when's the last time you even had a lollipop?
Bye-bye, Dum Dum Mermaid. No, I'm just kidding. Just kidding.
Wow.
You said it before.
Wow.
I guess it's better when we're just.
You're not that far away from me,
Hey, I'm protected in this glass shield.
I know.
I'm just telling you. All right, guys, that's a wrap. Good to be back together. Our cross-platform radio, TV, YouTube, Bloomberg Originals. We do love each other. I swear. We will see you. I know Alex is heading out. Scarlett's going to stick around with roommate.
She's already walking away.
All right, we will see you again. Same time, same place tomorrow.
This is Bloomberg Business Week Daily, reporting from the magazine that helps global leaders stay ahead, with insight on the people, companies, and trends shaping today's complex economy, plus global business, finance, and tech news as it happens. Bloomberg Business Week Daily with Carol Massar and Tim Stenovec, live on Bloomberg Radio, television, YouTube, and Bloomberg Originals.
It is Bloomberg Business Week Daily. That is Carol Massar.
I'm hungry and I want some gummies or something right now.
Did you say holiday shortened week?
Did I say holiday?
I don't know. It's not.
No.
Right?
No.
We're here all week.
Whether
you,
I know I am.
Whether you like it or not. Whether you like it or not. I did once take my son to school last year on a day when there was no school. That was not great.
Did you show up or did you
Yeah, I was like, why isn't anyone here? Yeah, so you only do that once as a parent.
Yeah,
Maybe twice. We'll see.
We're busy people.
We are, and maybe it's a good segue to talk a little bit about some ways to help with productivity. Maybe AI.
I see it coming, man.
Well, there's basically a handful of prominent chatbots out there. The most well-known is perhaps OpenAI's ChatGPT. You've got Gemini from Google, Copilot from Microsoft. You got Meta AI, and then there's Anthropic's Claude. We're going to talk about that last one, Claude, which incidentally, even before I knew this story was coming, I downloaded it over the weekend and spent quite a bit of time playing with it. It's very different
Did
than...
you like it?
Yeah, I like it a lot.
Why is
it's
it
cool.
different?
Because it's cut off. We're going to talk to Shireen about this, but it's cut. It said my knowledge base was cut off in October of 2024, so it couldn't give me some up-to-date information. I asked why it was cut off, and it said it's part of its safety. Yeah, Shireen's going to explain this all. Shireen Ghaffari is a Bloomberg News AI reporter. She writes for Bloomberg Business Week about Dario Amodei. He's the 42-year-old at the helm of Anthropic, and he's transformed himself from an academic into the CEO of a $61 billion company. I was going to call it a startup, Shireen, but I don't know if it still is at this
that's
point.
pretty serious.
You spent
Mega
a lot
startup.
you spent a lot of time with Dario Amodei when reporting this piece. And as you write, there's some good news and bad news when it comes to this technology. In his view, he's like, okay, it could cure cancer, but the bad news is that it could kill us all. What's he so worried about?
That's right. So he is really worried about essentially catastrophic kind of risks that can come with AI, right? And that may sound really sci-fi and doomery, but if you think about it, the types of risks that they're preparing for are if essentially you can get more detailed information from these chatbots about things like, let's say, how to build a novel bioweapon than you could if you just simply Googled. Because these AIs are becoming smarter and becoming more able to sort of give you very personalized information, they're having to deal with some pretty scary risks.
It's kind of interesting, and I feel like when we talk AI, most folks, I feel like, Shireen, tend to say, it's okay, we got it. We'll have the safeguards in place. And here's someone who really seems to say, this thing could be incredible, powerful, but there are risks that potentially come with this.
That's right. And it's not just the really long-term, existential risk. There's also, in the short term, a real economic impact. So Anthropic is actually quite ahead. Some people say it's the best. It's a matter of debate with their coding AI, meaning they make software that actually helps automate part of the engineering process. And over time, it's expected that these tools can essentially start to automate the entire engineering process, meaning what will happen for engineering jobs and sort of awkwardly for the company, what is that going to mean for its own staff, right?
Yeah, I mean, many of whom at this point are very highly compensated, because these are some seriously in-demand jobs and some people who have skills that are seriously in demand right now. I want to go back to the fundamental difference between Anthropic's Claude and what Anthropic thinks about this philosophically, Shireen, and how that separates it or makes it distinct from the other companies that are out there. What is Anthropic doing to try to become this, or to try to be this safety-first AI company?
Yeah, so first of all, Anthropic was started by a group of former OpenAI employees. And there's a lot of sort of infatuation, I would say, in the AI world about, well, why did they leave? You know, were there issues going on? They kind of remain intentionally vague about it, but they sort of set out to be a more responsible alternative, more safety-focused alternative than some of the other major labs at the time, OpenAI being sort of the one at the forefront. And how Anthropic says it's taking it more seriously today is that they put a lot of resources into some areas of research that are not monetizable, but are around safety. Things like what we call mechanistic interpretability, which means essentially trying to understand the black box of AI. So they put a lot of dollars and research heads toward that. And then they also have quite detailed protocols for how they should handle sort of every step forward as these AIs become more capable. So in my story, I wrote about, for example, how with their last big AI update, they actually pulled the brakes just days before the release and had to delay their launch because they were not sure the model was at the cusp of being more capable than they thought on the ability to potentially help people make bioweapons. So they say that A, they're putting the research toward it, and B, when it comes time, they're willing to actually pump the brakes and slow down if they think something is too risky.
As I was reading your piece, I was contending with the question of, does it matter that they're doing this if nobody else is? Because isn't the genie out of the bottle if the other companies aren't taking the same approach?
It's a great question.
That's a very good question. And, you know, what Dario Amodei, the CEO, would tell you is that, well, they hope for a race to the top, meaning that they hope that instead of everyone competing to go so quickly, they will create a sort of secondary pressure to be more responsible on, for example, the protocols before you release an AI model and checking for all these risks. And they point to things like, for example, they came up with a certain framework for safety testing prior to launch, and they show that other companies have put out similar frameworks after they did. So, you know, maybe there is some hope that they can exert positive pressure in the market on this way by being a more responsible actor and sort of creating a self-regulation. But that doesn't, I talked to a lot of people in the AI industry, and who also told me that doesn't take away, right, from the broader sort of just capitalistic pressure to deliver, right, to return on investment. And we're talking about billions of dollars invested here in this company and others.
I mean, what's it going to do to this company, though, like to build on what Tim is saying? Like if they're the lone, wolf out there kind of doing the right thing, where does it mean? Does it set them back? Is it just going to be a matter of time where everybody just kind of rolls over them? I just wonder how that plays out.
I think it will be the challenge ahead, right, is how do they sort of balance that ethical commitment to continuing to innovate at this fast pace. One thing that has worked in their favor recently is that they have seen sort of a mini exodus of OpenAI employees and researchers who were worried that OpenAI was not committed enough to its safety standards, who left. And of course, this is a fiercely competitive market in the AI talent space, right? So even, the company confirmed half a dozen prominent researchers have left from OpenAI to join them. That group, even if it's small, can make a big difference when, again, you're operating under such tight timelines to innovate.
Shireen, you're out there in San Francisco. You're around this technology and these people all the time. Should we be building bunkers?
Oh my God, Tim.
It's really funny because you can take a straw poll of 20 leading people in the AI industry here in San Francisco, and maybe half of them will tell you, you should absolutely be worried. Creating a bunker is totally rational. And the others might say, you are totally, freaking out. Everyone needs to, sort of take a chill pill and just grapple with the fact that these tools are not even close to actually causing existential threats yet. But here's the problem. When a technology is moving so quickly, how do you anticipate the rate of change, right? Even if they can't do that now.
I was just going to say to Tim, I'm like, so what does that bunker look like? I mean, do we even know what we kind of have to protect ourselves. Maybe
You just better have a lot of food.
Maybe Musk and Mars isn't such a bad idea.
Okay.
If it's AI
6 months to get there. Shireen Kafari, Bloomberg News AI reporter. Check out her story. It's fantastic.
It's 421 on Wall Street. We do check markets all day long here at Bloomberg. Stocks rebounded with the S&P 500 index closing near a bull market. Traders look past the U.S. credit downgrade Friday by Moody's ratings. The Dow, the S&P, NASDAQ all advanced today with the S&P 500 index up 5, up just about 0.1%. The Dow higher by 137, up 0.3%. NASDAQ managed to eke out a gain in the final few minutes of trading, higher today by 4 points, little changed on the Monday session. The 10-year, 4.44%. The 2-year, 3.96%. Gold up $26 the ounce, up 0.8%. And West Texas Intermediate crude up 0.3%, 62.68. Gold, by the way, at $32.30 the ounce. And this Bloomberg Business Flash is brought to you by Oracle. Attention growing businesses, Oracle is offering to cut your current cloud bill in half if you move to Oracle Cloud Infrastructure for new U.S. customers with minimum financial commitment. See if your company qualifies visit oracle.com/Bloomberg. Novavax shares surged today after regulators fully approved its COVID vaccine. Novavax today up by 15%. And sources tell Bloomberg the Justice Department has opened a probe into a recent breach at the leading cryptocurrency exchange, Coinbase Global. Coinbase today did decline by about 0.9%. For on-demand news 24 hours a day, subscribe to Bloomberg News Now wherever you get your podcasts. I'm Charlie Pellet. That is a Bloomberg Business Flash.
Hey, thanks so much for that update, Charlie. Do appreciate it. Well, shares of the Israel-based AI-powered customer service platform NICE fell 5% last Thursday. This was after the company reported results last week. NICE did report adjusted earnings per share for the first quarter that beat the average analyst estimate. It also increased its non-GAAP earnings guidance for 2025. We've got with us Scott Russell, the CEO of NICE. He joins us from Dallas. Scott, good to have you with us. NICE has a market cap of about $10.7 billion. You sell your services, which helps companies automate customer service, to companies all over the world. We're talking Disney, Pfizer, Sony, Verizon, Toyota, Visa, and more. So you've got a great view of the global economy, and that's really where we want to start. I just want to get an idea from you how you're seeing spend, what you're hearing from your sales force when they go out to these meetings and sell NICE's services. Are there any signs of strength? Are there any signs of weakness? Well, how would you characterize it?
Yeah, so it's great to be here. Great to speak to you, Tim. So in very simple terms, the demand for leveraging AI in all of its forms, we'll talk about customer service, but leveraging AI as a technology spend to be able to deliver better value for customers, better service to customers, better automation for business, that continues to rise. Our pipeline continues to expand, and that's true right here in the United States, but also around the world. But they're also even more clear about an uncertain environment and how they're going to retain the loyalty of their consumers. Brands are concerned about what the economic environment is going to be and whether they can retain the loyalty of customers that are worried about what they spend their dollar on and making sure that it's going to be on their business. So brand loyalty combined with AI is what we see from the demand out there in the market.
So I think people listening or watching right now might ask the question, wait a second, this is a software as a service, this is a B2B company. I don't necessarily see NICE's services, though I might actually interact with them because you do use AI to power customer service. That's the platform that you sell. Explain how consumers would run into it.
Yeah, it's a great question. So let me give you a real example of a company that many consumers know, Sony. So Sony are a company that provide their technology to consumers all around the world. Now, what they found was the interaction when a consumer had something, they had a question, an issue with their product, maybe it was on the delivery, the logistics, when it was going to be provided, service quality, majority, 40% of their inquiries could be automated. They wanted to, they boosted their self-service. They used the AI platform with NICE to be able to self-automate that, and they got record satisfaction scores. In fact, there's a bit of a misnomer out there about the role that AI plays. We've seen clear analysis that when AI is used to be able to provide better resolution, faster response time to consumers, actually the loyalty scores go up versus speaking to a human agent. So that's where the consumer engagement with a SaaS technology platform to be able to resolve their questions faster, easier at any time of the day, 24/7. That's when it becomes really impactful to every consumer, including you and I.
Hey, Scott, how quickly is all of this ramping up in terms of companies saying, okay, I get it, and quickly looking to kind of add it on to their platforms or adjust their platforms to make sure that they can take advantage of it and monetize it?
Yeah, it's incredible. I think the world saw when Gen AI first really hit our daily lives, we were able to use it in a consumer experience, whether it was getting information, being able to do some fun things, but then it quickly turned into how businesses could leverage this. Now that is efficiency for employees. Mm-hmm. It's quickly made its way into customer service. Because if you think about it, the best use case of an agent, an AI agent, an agentic AI, is when you're interacting with an enterprise, you're wanting to getting a task solved, a service delivered, an appointment made. And so what we're seeing is fast adoption of this technology compared to 12 months ago. But businesses also need to balance that with more difficult or more detailed requirements where it still requires the human agent to be able to help their customer service representative. So we're in that world of transitioning, leveraging the technology quickly, but making sure they have the full service capabilities, such as the Disneys, the Sonys, the Marriotts, the Toyotas, and others that you mentioned at the beginning of the show.
So help me understand, Scott. Maybe it's just because I've done some traveling and doing some stuff and dealing with a lot of customer service reps and driving me crazy and losing like 45 minutes of my time. And I kind of said to my husband, "Sweat, I never can do this stuff at work because it takes so long." And so help me understand how that experience truly is going to be better for all of us and maybe not use up so much time. Because what I feel now is a lot of questions and I've got to answer question and question and question. It's still time consuming.
Yeah, Carol, it's a great point. And as consumers, we all feel it, don't we? We're all, we're nearly afraid to get on that chat or that call to our, to the brand that we're contacted to because we're worried about that time-consuming experience. That's exactly the business that NICE is in. And if I go back to that Sony example, 40% of their inquiries were a long time consuming, clicking, hitting numbers, going through their IVR, ultimately getting to a customer service representative, only to find that that information can be solved very quickly. Whereas now, Sony's able to deliver that information through a click, through one chat, 2 or 3 interactions, a matter of seconds or minutes, not a long period of time. So they get the information they need as fast as possible, but also with high quality as well. And that's where the consumer experience, because we don't want to sit on the phone. We don't want to stay on long-term chats. We want to be able to interact with the brand, have a positive experience, and then get on with our daily life. And that's the change that the AI brings to our platform and how we can help brands become better engaging with their consumers.
Do consumers realize they're interacting with AI?
Great question. So you put regulations there is regulations around the world that provide a requirement to inform consumers when they are interacting. That differs around the world, and we obviously work within that. So I think consumers do, but what you'll find is that's usually because the interaction becomes very clear when you're speaking to an AI bot and then when it goes to a human agent. And most brands will notice that transition and you'll be able to feel that. What you'll find going forward is that the AI bots will become more and more human-like, and as they should be. They'll be able to conduct workflows, they'll get tasks done, they'll be able to provide knowledge and they'll be able to self-learn to be able to adapt to the consumer requirements. So I think what you'll find is more and more of the needs of us as consumers can be fulfilled in an automated way, meaning customer experience is better. But the complex things or the specific asks, you're always going to have a human agent there available. The only other comment I would make is when the human agent gets brought into the loop, it needs to be value adding and it needs to be something that you continue that human empathy and that service orientation. So I think it'll get better and better, and certainly my business is very driven to make sure that's the case.
So where do you go from here? And I guess what I'm wondering too, Scott, is are there going to be, you guys are, almost an $11 billion market cap company. I'm looking at, revenues for the most recent quarter, adjusted revenue of about $700 million. But I'm just curious if this environment will have lots of companies like yourself that are working with different companies to do this, to automate, to use AI, to interact, to have companies to enable them to maybe interact more easily and maybe better and more productively with their customers and their clients.
Yeah, so the way I view this, we believe this is a long-term industry trend. Customer service, as even you, Tim and Carol, you both spoke about, we have a negative connotation sometimes when the experience wasn't a great one. But we also remember the great experiences when we do. And I think historically, customer service has been about automation and efficiency and trying to deliver a contact center at scale rather than a delightful customer service.
I really feel like it's been about making it easier for the company and cutting costs and people and whatever else is out there, but putting the onus back on the customer to kind of figure stuff out and spend more time on it.
And that's what we're really driven to, because we believe you can do both. You can get the efficiency and the automation that undoubtedly AI brings. You think of in our company, we have 15, 20 billion interactions on our platform. So we know what consumers want, when they want it, how they want it. We know all of that data, and we're able to provide that in both a human and an AI context, but it needs to deliver a delightful consumer experience. And I think what you see now is businesses are no longer accepting a poor, customer satisfaction score with an efficient organization. They need both, especially now, given there is a high sensitivity of consumers.
Right.
They're worrying about where so it's even heightened, and we believe that will drive further growth in the market that needs that disruption.
So I guess my question was really like, do you go it alone? Do you tie up with someone else? Do you need to acquire other companies? Like, what's the future trajectory? So
I genuinely believe that while our technology at NICE is fantastic and we're proud of it, we need to do it in collaboration with others. And when we recently announced a major partnership with Amazon Web Services,
right.
They've got an incredible data platform and AI platform. We partnered with ServiceNow because they really do help drive the workflow between the front, the middle, and the back office. And often what we're asking for as consumers is information in the back office, logistics, credit information, billing information, and we need to be able to draw that at the point of interaction. But you're right, we're also looking at our portfolio and continuing to expand our AI capability in self-service, being the market leader that we are, and continuing to step ahead so that we not only are valuable to the brands that we serve, but ultimately the consumers who are working with them.
All right, so 10 seconds, is that a yes, that you're going to need to acquire companies?
Yes, we are.
Okay.
Yes, we are.
Wait, could you be a tag-on for AWS, Amazon?
Oh, in partnership with AWS. So we're in full collaboration, and we announced that partnership, same with ServiceNow. So partnerships, not acquisition in that side.
We'll stay in touch, Scott. Look forward to future conversations. Scott Russell, he's the CEO of NICE, joining us from Dallas, Texas. Coming up next, we're going to get into the tiny bank in Trump Tower that's reportedly enriching the president's sons.
It's 4:40 on Wall Street. We do check markets all day long here at Bloomberg. Turned out to be an update today for the Dow, the S&P, NASDAQ Composite Index, NASDAQ 100 Index, down day for the Russell 2000. Got to keep in mind quite the turnout for the U.S. stock market after Moody's on Friday. Today we had the S&P climbing 5 points, a gain of 0.1%. At the worst level of the session, we did have the S&P 500 Index down by more than 1%. The Dow up 137, up 0.3%. NASDAQ higher by 4. Little changed on the day. The NASDAQ 100 Index up by about 0.1%. 10-year at 4.44%. The 2-year 3.96%. Gold up $26 the ounce, up 0.8%. West Texas Intermediate crude up 0.3%, 62.68. And Bitcoin now up 1.3%, 105,479 on Bitcoin. Investor Day at JP Morgan Chase, CEO Jamie Dimon is warning against complacency, citing risks such as inflation, credit spreads, and geopolitics.
I never believed we were as exceptional as people were saying. I never believed that Europe was as bad as people were saying. America's asset price, still think they're kind of high. I'd put that in the risk category too. And credit spreads are kind of low. I'd put that in the risk category too. I think both of those things may change.
JP Morgan Chase CEO Jamie Dimon at Investor Day. Novavax jumped today after U.S. regulators fully approved its COVID vaccine, easing investors' concerns after the clearance was delayed. Novavax today surged by 15%. For on-demand news 24 hours a day, subscribe to Bloomberg News Now wherever you get your podcasts. I'm Charlie Pelleton. That is a Bloomberg Business Flash.
Hey, thanks so much for that update, Charlie. Do appreciate it. Well, if you go up to the 22nd floor of Trump Tower, you'll find a company called Dominari Holdings. It's the operator of a tiny investment bank that less than 3 years ago pivoted from developing cancer therapies and went into finance. Since then, it's lost about $70 million.
It's a pivot.
Yeah, that is a pivot.
Anyway.
Guess who's involved in this?
Read on, please.
Okay, well, one of its senior executives was named in a now settled complaint alleging boiler room-style business practices at an earlier employer. It's now been stockpiling Bitcoin. For years, its shifting priorities and tribulations remain largely out of the spotlight. That changed, though, when it gained two recognizable backers, Donald Trump Jr. and Eric Trump. Annie Massa is Bloomberg News wealth reporter. She writes about Dominari Holdings, and she joins us here in our Bloomberg Interactive Brokers studio. You followed the money in this case.
That's right. So a bunch of things that a bunch of announcements have come out over the past couple of months involving the Trump brothers, and it can be hard to keep up with them almost. So Trump's two eldest sons joined the advisory board of this small company called Dominari, and it wasn't a company that I'd heard of before. So we basically just started looking into its financials, and you don't have to look far to see its headquarters, which is right in Trump Tower. And its business model, which is, as you said, a little bit unusual. It's done a hard pivot from biotech and developing anti-cancer therapies to investment banking and underwriting IPOs. And so we dug a little bit further.
How did the two Trump sons, or two of the Trump sons, Eric and Don Jr., get involved?
They joined in February the advisory board, so they've become advisors to the company. But there are
And it was already located in Trump Tower? Like, has it always been in Trump Tower?
It was already in
Okay,
Trump Tower.
sorry. Okay, go ahead.
But it does have other Trump Organization connections beyond that as well. In December, after President Trump was reelected, of course, Ron Lieberman, who's also an executive at the Trump Organization, joined the actual board of directors of this company. So there's that connection. There are also other executives from the Trump Organization, including the chief legal officer, who own large stakes worth getting up into the millions of dollars combined in this company. So there are all these ties back to the Trump Organization. Stepping back, what Dominari does, though, is it underwrites IPOs that can be seen as kind of, they're penny stock IPOs, basically. And the company loses money, and that's what kind of I found compelling about it and compelling about the story. What do the Trumps see in this company?
What do
why
you
they
think?
get involved?
Well, okay, so they've been involved only for a few months. They're compensated very well, according to your reporting. Talk a little bit about that and maybe answer the question that you found. What do they see in this company?
Right. Well, what Eric Trump has said is that Dominari. So Dominari, I did interview the CEO of the finance arm of this company in February, and he said the Trumps are friends and that he was a member of their golf club in Jupiter, Florida. The Trumps have said the Trump organization didn't respond to our request for comment, but in other news outlets, Eric Trump has said that the Dominari Dominari has brought them great deals in the past and that they've been involved in great things together. So they speak highly of each other. But it is a phenomenon when you look at what happens with the Trump, with the Trumps joining as advisors to some of these companies like Dominari, there's a pattern, which is that the shares tend to spike because an announcement hits that they're involved, and then the shares tend to spike. And that's exactly what played out with Dominari. Shares of the company, because it trades for kind of low dollar value, spiked more than 80% that day when the Trumps joined. So that in turn makes their stake worth more.
I mean, the stock is up almost 500% year to date, right? I'm reading that correctly. You're right. It's like a $5.63.
Right, but you're talking about a stock, right? You're talking about a very low price stock.
Correct. But it's still like crazy. And if somebody had put money in early on, potentially could have earned a lot of money. I guess what's interesting, going back to the IPOs, is you say the IPOs that it's been involved in since shifting to banking, you guys note in your reporting about 1/3 have plunged, more than 75%, according to a Bloomberg analysis. Some lost almost all of their value in less than a year of hitting public markets, and many are based in Hong Kong and China and trade as penny stocks. I mean, to be fair, like those of us who've been doing this a long time, like when we see a name like that or where it trades, we tend to be somewhat dismissive because it usually doesn't pan out to be much. And I think that's safe to say, right? So it's just interesting that tends to be their business practice.
Yeah, you could look up the IPOs that the company, that Dominari has underwritten recently, and some of them you'll see the classic pop and then fall off. And we found several where they lost almost all of their value after the IPO. So, I mean, it does raise questions about the quality of some of those IPOs that it's underwriting.
I mean, what did you want to know, Annie, and you guys reporting this out? What answers did you feel like you got some information, and what things kind of still are questionable, or that you still like, God, I still would like greater answers or more, more information about some things?
Well, there's a lot there. So you have this relationship between the Trumps and the Trump organization and this company that's done this big pivot. The other reason that it's become relevant recently is it is involved in one of the crypto transactions that Eric Trump and Donald Trump Jr. have done. So there are a lot to keep track of. We won't go into all of their various crypto ventures, but one that has maybe flown under the radar a little bit in comparison to something like World Liberty Financial,
right?
Which is a separate company that they promote, has nothing to do with Dominari. Dominari created this American data centers unit that then became a Bitcoin mining company very shortly thereafter. The Trumps are involved in that as well, or were named in that kind of release as well. So it's spinning off new businesses, and that's supposed to IPO. So that creates another opportunity for potential profit and an increasingly perhaps complex web of financial ties.
Just 30 seconds, the Trump family has pushed back on questions about conflicts around this, given their proximity to the president. Did you get any commentary from them about this?
That's right. Their opinion and what they've said on the record is there aren't conflicts here, and what Donald Trump Jr. has been very vocal about is that he says, I've been a businessman my entire life, it doesn't matter, but I'm providing for my children, I've been a businessman my entire life, and that's his perspective on it.
Just fascinating, just interesting, right?
They're involved in everything, it seems like now.
And to be fair, things that wouldn't probably be on our radar, but, they are the sons of the president, and so just kind of tracking all of this stuff. Great detail in this story. Highly recommend you check it out. Annie Massa, thank you as always. Wealth reporter here at Bloomberg News right here in our Interactive Brokers studio.
This is Bloomberg Business Week Daily with Carol Massar and Tim Stenovec on Bloomberg Radio.
All right, everybody, we are getting ready to wrap up on this Monday
It's a Monday,
edition.
Carol.
I know. It's only Monday, woman. I really did think it was Tuesday. I don't know why.
Tomorrow, do you think it's Wednesday?
No, I'll know it's Tuesday. All right, everybody, you are listening and watching Bloomberg Business Week, a day where it feels like investors kind of shrugged off in many ways that late Friday downgrade by Moody's when it comes to U.S. Treasuries.
I'm Tim Stenovec, along with Carol Massar. Let's take a look at some stocks on the move today. Joining us now is Bloomberg News equities reporter Alexandra Semenova. Alex, what is on your radar?
Hey guys, so it was actually kind of an uneventful day in the market, closing flat after the U-turn, but there were some interesting
drama earlier in the session, right?
Exactly. Everyone shrugged it off. We're all good now, but one of the companies I'm looking at that is doing really well today is the bankrupt genetic testing firm 23andMe. They agreed to sell their data bank to Regeneron Pharmaceuticals for $256 million, which is kind of scary, just sharing people's data, but investors seem to like that. It's up about 200% today.
What was 23andMe at its height? Do we even know?
I can go back and look.
Okay. I didn't mean to throw that at you, but I was just curious. Like, it is kind of amazing. I thought, wow, what a lifeline for this company, right? That has been around for a long time, but really got into certainly kind of a tougher place, I guess you could say.
Yeah, and we know, some of the retail investors love buying up these bankrupt stocks and seeing if they can see these types of swings like we saw today. And obviously that fared well for anyone who stepped in.
It was a $353 a share stock.
What? Back
in February of 2021, not so long ago. It was, $2.70 a share.
Yeah, incredible.
But listen, it found a new home, which is pretty impressive. Let's go to Reddit. Reddit under some pressure today.
Speaking of, meme stocks, got to talk about Reddit.
Well said.
They got a downgrade from Wells Fargo. It fell 4.6% today in today's session. They downgraded the stock to equal weight from overweight. They pointed to user disruptions that are likely to be more permanent as Google aggressively implements AI features in its search. They said that that changes user behavior for the company, and obviously investors really didn't like that.
This one, you use Reddit, I thought, all the time.
Yeah, but I had to hide
love
it.
Reddit.
I had to hide it on my phone.
Oh my
I
God.
love it. Yeah.
My friends make fun of me because I look up everything on Reddit, just like random questions.
So are you actually using the Reddit app? You're going to Reddit and searching there, or are you like going to Googling something and then you put in Reddit
I actually, use Google and pull up Reddit threads.
This was part of the cover story of Business Week a few months ago when they were when our team was writing about the challenges that Google faces in this AI world. I've now started to, Cece does the same thing. She Googles stuff and puts Reddit on there. I've now started asking the AI chatbots the questions because they're some of them are sourcing from Reddit as well. OpenAI, for example.
So do you say go to Reddit?
No, I just asked the question that I have.
And then it goes to Reddit?
No, I mean, it informs, it's whatever it's been trained on, but you can see at least with ChatGPT what it's searching on, where the sources are, and oftentimes it is Reddit.
So why is Google more aggressively implementing AI going to hurt Reddit? Wouldn't it potentially help people? You should see the faces.
It seems like it doesn't necessarily direct to Reddit. That must be the issue. Yeah, it threatens not only Reddit, but all firms dependent on search traffic. And I guess today in particular with this downgrade, it's...
Oh, yeah. That's a really good point. If it shows you that instantly, and this is also raised in the story at Bloomberg Business Week, if it just shows you the answer and you don't need to click through to the site, then obviously the site won't get the click for that.
So you get the answer, you understand the source, and you're like, I'm good with that.
And now it just pulls it up in that little blurb when you Google something that says AI overview, and you're no longer going directly to Reddit.
I'm kind of mixed about that.
Are you?
I am a little bit.
Seems like you like it a lot. Just based on looking over your shoulder at how you're Googling.
It makes things more efficient for us, but I guess not for the company.
I don't know. I have a love-hate. I like to know, sources. I like to drill down a little bit and understand where this information...
There's a little link in there.
I know, but you know what I mean? I kind of want to know.
Okay, she loves cruises.
I love...
She loves ships.
Small cruising.
Royal Caribbean is on your radar.
Great news at a time that everyone is talking about Moody's downgrading the U.S. Royal Caribbean actually got an upgrade. They regained their investment grade status from Moody's. They cited a stronger demand outlook and better credit metrics. And that stock actually closed down just slightly, 0.5%. But analysts were pretty positive on this. Moody's Jonathan Root wrote in a statement, the upgrade and positive rating outlook also reflects our expectation that the demand for cruises is going to continue to grow.
I have to say, you talked
especially from Carol.
You talked to the cruising guys, though, all the CEOs. I mean, some of the metrics, and they talk about, you know, how much visibility they have in people booking out like a year out or so in terms of their cruises. And these guys all took on so much debt during the pandemic and have really been working on paring it back and cutting it, you know, reducing it, or at least refinancing it so it's not so problematic. So that's kind of interesting. You're not a cruiser?
I'm not. I haven't
What do
been
you
on a
do
cruise
for
in
like
a while.
vacation?
I book random trips. I'm going to Guatemala next week. Very excited about that.
By yourself?
No, with a couple friends.
Okay, just checking.
Wow, what is this turning into?
I don't know.
We're just all gonna outline our summer vacation.
Yeah.
plans
It's
now.
that kind of day, right? It's kind of like a day.
Exactly. It
and
was
so
very uneventful.
we're going elsewhere.
For more conversations like this, well, let me do that again. I want to thank Alexandra Semenova for dealing
As
with
you
us.
should.
Thank you guys. It's always a pleasure to be on with you.
It's good to have you here.
She's Bloomberg News equities reporter. For more conversations like this, listen to our new Stock Movers podcast. Subscribe for 5-minute episodes on the biggest winners and losers in the stock market. Listen to Stock Movers on Apple, Spotify, or anywhere you get your podcasts.
All right, everybody, we are getting ready to wrap up on this Monday edition of Bloomberg Business Week. Just a reminder, up 5 points on the S&P 500 in today's session, up about 137 points on the Dow Jones Industrial Average, the NASDAQ 100 finishing up about 19 points, so onward and upward.
Tuesday tomorrow, Carol. Tuesday.
Only Tuesday, Lemon, almost. All right, that does it for Tim and me. Have a good and safe evening, everybody. Balance of Power starts right now.